But Yung Ha is the chief economist and the head of economics at the Reserve Bank. Yung, it's so nice to have you with us and your expertise. Thank you for joining us. Are you somewhere? Are you out the back with the printer?
Metaphorically, we are. I mean, that's one of our special powers. Central banks can print money or create money. These days it's done electronically. We're in a digital world. It's not analog. We're not physically up there cranking the handles and money coming out.
But can I come back to my obsession with, and we're talking metaphorically, you're obviously not printing real money, but you are creating money. Who gives you the right to do that? Who says you can?
Well, the government does. I mean, it's our superpower, if you like. Legislation says that the central bank, all central banks have that superpower to create money.
The money we have in our pockets is just paper or base metal. But as long as a currency retains public confidence, the intrinsic value of banknotes and coins is irrelevant. Its value is derived solely from its acceptance as a medium of exchange. However, that has not always been the case. Until early last century, most major economies had adopted the gold standard. Banknotes in circulation literally represented a share in a country's gold reserves. Theoretically, a central bank could be called upon to exchange any banknote for its value in gold. So it was the task of the central banks to ensure they kept sufficient gold reserves to back the currency in circulation. Today, however, money derives its value from its purchasing power, the value of the goods you can buy with it. So the job of a modern central bank is mainly to make sure that the amount of money circulating in an economy is properly balanced against the value of the goods that it can purchase. In that way, the value of the currency can be protected.
Ryland, your article is about how money gets created. We're surrounded here by gold in the vaults of the Bank of England, and historically in the gold standard, the amount of gold would have been related to the stock of money in the economy. Things are very different now. In the modern economy, where does money come from? Your article focuses on broad money. What determines how much of that there is?
Well, broad money, which in many ways is a better measure of the amount of money circulating in the economy, includes all the bank deposits of households and companies. And one of the key points of the article is that banks create additional broad money whenever they make a loan. Now, while this is nothing new, it is sometimes overlooked as the main way in which money is created. And it runs contrary to the view sometimes put forward that banks can only lend out deposits that they already have. In fact, loans create deposits, not the other way around.
Okay, just finally, I just was hoping to ask you a little bit about the issue of money creation. Now,
here's some.
We get a lot of comments on our site about this, and you're probably familiar with the papers that came out of the Bank of England 3 or 4 years back. I'll just read you a little bit from this. So one of the things they said is when a bank makes a loan, for example, to someone taking out a mortgage to buy a house, it does not typically do so by giving them thousands of pounds worth of banknotes. Instead, it credits their bank account with a bank deposit of the size of the mortgage. At that moment, new money is created. Now, this has created a perception that banks can create money out of thin air and they don't really necessarily need to borrow through deposits or bonds from the public as they do. These two things seem to be at a bit of conflict. So I'm just curious as to what's the take from you?
They can create credit, and that credit has to be good credit because they need to get it back to pay the people who they borrowed from. And that's why
I put it to you, we're a small open economy. We have high levels of private sector debt. Mum and Dad have borrowed that debt effectively from foreigners because their local bankers sourced that from foreigners.
When our Reserve Bank governors keep repeating that the Reserve Bank in New Zealand banks the banks, it is a very confusing statement because it implies that the buck stops with the Reserve Bank in New Zealand when in fact the Reserve Bank in New Zealand is in turn banked by banks external of our economy, which sees 95% of our currency originated indirectly as loans of fiat credit from these external institutions. The implications of global liquidity developments for New Zealand. New Zealand banks fund a significant proportion of their balance sheets by accessing offshore wholesale debt markets. They do this by borrowing in foreign currency, then swapping this back into the New Zealand dollar. Conditions in global financial markets are therefore an important determinant of New Zealand bank funding. New Zealand banks tend to focus on the primary market, new issues, rather than the secondary market debt. Hence, funding liquidity is more immediate importance than market liquidity. New Zealand banks typically use market makers to help facilitate foreign currency swap league involved in borrowing from offshore. Market makers take the other side of the transaction with New Zealand banks. This is via settlement accounts at the Reserve Bank, I add. Market makers take the other side of the transaction with New Zealand banks providing New Zealand dollars in exchange for foreign currency that the banks have raised or charging a spread.
Speech. I won't say as you know, because I'm not sure people do know that we have actually three main strands of work at the central bank. The first one, of course, is monetary policy. We are the proud monopoly supplier of the fiat currency, the New Zealand dollar. And the second strand of our work, of course, is promoting financial stability. We aim to both lower the probability and the impact of financial institutions and insurers getting into trouble or failing. And then the third main strand of our work is delivering all of the other functions the central bank delivers, ensuring the supply of cash throughout the economy, transactionally banking the banks themselves, and overseeing and operating all of the critical payment and settlement systems. So those latter two roles are often overlooked because of the excitement of the headlines of what have we done with the official cash rate. Through all of this, we aim to be transparent and understood by the broad public. In the financial stability place, we're faced with very similar trade-offs. Our remit says that the government wants a financial system that is strong, efficient and inclusive. As we know, if you want to make a bank strong, you limit the amount of risk-taking they can undertake. However, by doing that, of course, you undermine then the efficiency of the financial system itself. Modern banks and regulators, I say modern, in the last 200 years, realise that lending out deposits is a manageable risk. Likewise, borrowing short-term for the banks, deposit rates, and lending longer terms is also a manageable risk. But we have to accept that risk and we have to be able to manage that risk. Resilience now is about almost all activities in New Zealand, from the Cook Strait ferry through to getting cash out of an ATM. We are so thinly spread. It's all just in time. There's no just in case mentality going on in corporate society. And so we need to build up that resilience. We need to have, in the simple cash management side, yes, you may not use it day to day and all the time, but when you need it, it has to be available and immediately. So what are we doing around increasing that resilience, the availability of cash, the ability to store cash across regions, so on and so forth? That is critical. And a central bank digital currency is not going to remove the need for that resilience. You are going to have to be able to operate without power and without communications and without the law of the gun deciding who gets the loaf of bread. So that is critical. A central bank digital currency, meanwhile, is simply an electronic signal that sits in the central bank that says, I owe you something. So it's no different to an electric signal that sits in a retail bank, except this time it's with the central bank, and because it's with the central bank, it's narrow money. It is the true fiat currency rather than broader money created by the retail banks themselves, through fractional banking. So it's the equivalent of having a physical $1, a physical note. You've got an electronic signal with the same inside a high-powered one-to-one relationship. We all know this, and I don't want to create a sudden rush for the door if you're just realising it, that if we all went to try and take all of our deposits out right now, the banks wouldn't have it. They lend out far more than they physically hold, and that's fractional banking. But with the one-to-one central bank digital currency, it's there. It's backed by the Crown balance sheet, current and all future taxpayers. So that's the idea. Who holds that electronic signal is the really critical part. Does the central bank hold it and bank everyone transactionally, or does the central bank allow retail banks to hold that electric signal and customers have a choice between Bank A money or central bank money on their accounts? How do they split those two? So that is where it gets important, because the central bank is not the risk allocator of capital around. That is done through the very important role of banks to allocate that capital on a risk-based manner. So it's so simple at the heart. What makes it different to a Bitcoin or to a stable coin? Well, it's the central bank's money. It's not someone else's IOU or I promise. It's not Zuckerberg's promise or around I'll be good for it if you ever need it back. It is a fiat currency promise.
Given that you've been talking about digital currency, and so we're looking at the balance sheet of Te Pūtea Mātua, are you having any issues that the Deutsche Bundesbank is currently having with a very bad P&L with all their very low paying bonds that they're holding? Is that something that's emerging for Te Pūtea Mātua?
Well, I notice an emotion there. You use the emotion bad. What is the balance sheet of a central bank? The central bank doesn't even need equity. We print the stuff. So it's the world where accountants have met the world of economics, and at the moment, central bank mark-to-markets around the world are either positive or negative. It doesn't make any difference to the actual central bank unless somehow their credibility is being attacked, i.e. You're printing money with no sense of ever making it low, stable inflation through time. So that's the Venezuela or the Zimbabwe or the Argentina. Meanwhile, central banks who are committed to low and stable inflation and have that credibility, the equity in the balance sheet is effectively noise. So, but wow, it looks different. Oh, I haven't seen that before, and I was told in accounting, you must have positive equity in this. So it hurts the brain, but you need to exercise that brain, and there's some wonderful reading around central bank balance sheets. The BIS are out on their public mission at the moment to explain to people, calm down, it's okay. I love the US Federal Reserve's balance sheet. They are always square at the end of the day, because the way they do it is their equity is the discounted future seniorage that they get. And so magically it balances off each day. I'll let you think about that.
Sorry, my point was actually more the P&L. I know the Deutsche Bundesbank was, obviously pays out surpluses and it pays deposits for its retail banks. It's got into a position where, in fact, the money that it's earning of its portfolio is significantly less than the deposit money it's paying out. I mean, again, it could well be just an accounting issue rather than a real issue, but it's certainly something that's quite live.
It's making headlines. It's a reputational challenge. That's about balancing reputational, operational, financial and legal risk. Reputational, if you've said our reputation is based on us having positive capital and then you don't, well, you've got some explaining to do. The Reserve Bank is quite unique, and I won't say optimal, it's just unique at how it is. We were given a slug of capital and we're told to pay dividends anything over, above or below that capital. But quite what that capital means, I'll leave it to the BIS to explain to the public. Kia ora. Thank you.
All right. Thank you, Adrian. Much appreciated.
Cheers. Wonderful.
That's very dangerous territory for a country that's capital strapped, that has massive net external liabilities. I mean, no OECD country borrows more of its borrowing from foreigners than New Zealand. So if you put a tax on that, you have to get into the definition of what is hot money, what is legitimate investment in New Zealand. You run the risk that you ultimately force up interest rates, and that's a more expensive burden on the economy. So
But while that inner guts of the system, the web of contracts, is important, the even more important driver of financial instability is simply rising leverage of a particular form, and a particular form on which finance theory and macroeconomics has been entirely silent, or mainly silent, or to the extent that not silent, it has been wrong. If you pick up most undergraduate textbooks, and we were talking earlier this morning about the role of what we have to do in teaching undergraduates and graduate economics, and you see how they describe the role of the banking system, they make two mistakes. First of all, they describe a system which takes money from savers and lends it to borrowers, failing to realize that the banking system creates credit, money, and purchasing power ab initio, de novo, and with an important role, therefore, within the economy. But also, again and again, it says, well, what banks do is they take deposits from households and they lend money to businesses, making, as Joe referred to earlier, the capital allocation process between alternative capital investments. As a description of what modern advanced economy banking systems does, this is completely mythological. This is very well described in a forthcoming paper from Alan Taylor and Maurice Schullerich, reflecting some INET-sponsored research. Basically, in advanced economies, 80–85% of our bank credit is not to do with funding capital investment. It is funding two things. It is funding either consumption, that may be valuable, but we need to understand why that is, why funding a consumer credit would be valuable and to what extent, and the vast majority of it funds real estate. Sometimes either residential or commercial. Sometimes that is funding new real estate investment, which is a form of investment in the economy, but most of it is funding the purchase of already existing real estate. And it is fundamentally funding in a credit form a competition between ourselves for the ownership of locationally specific urban land. And that, I think, is absolutely fundamental to the instability cycle, because it is that competition for the ownership of existing real estate and of locationally specific land which is in relatively fixed supply that creates instability. Because if you put together the fact that the banking system that can create infinite quantities of credit and money and purchasing power, and that urban land which is locationally desirable is in fixed supply, whenever in economics you put together something which is infinite and something which is fixed, you get an inherently undeterminate price. We have at the core of our financial system something which is bound to create inequality, bound to create credit and asset price cycles and booms, bound then to create crisis and debt overhang and the balance sheet recessions about which Richard Koo has talked so importantly. That really poses a fundamental challenge, because it means that we have a free market system which, left to itself, will create a problem not just of a deadweight cost of too much activity in intra-financial activity that we don't need, but will also create too much of the wrong sort of debt. But with the irony that each one of that debt, seen as its own, looks perfectly socially useful. How could you deny that somebody borrowing for a mortgage is socially useful, but the collective impact of it is something which is incredibly difficult for us to manage and a fundamental problem at the interface between finance and macroeconomics? But to pick up your general point, Paul, I mean, you're quite right. I have posed this question of why is growth so credit intensive, and why does it appear to need to be so credit intensive? And to set out a sort of stylized fact, for the last 20, 30 years, rich developed economies have grown with nominal GDP growth rates of about 5%, but they've had nominal credit growth of about 10 or 15%, which necessarily means that the leverage ratio relentlessly rises, and I think eventually produces a point of a Minsky moment, a crisis, and a post-crisis overhang. And that does pose a fundamental question for us, which is, did we need that credit growth to achieve that nominal GDP growth, i.e. a rate of growth of inflation of about 2–2.5%, and real growth? If it is, if we really needed that credit growth to have the nominal GDP growth, then, as Minsky once said, we do not have an equilibrium in a monetary economy with capitalist financial institutions, as against in a Arrow de Breu, Valrasian, seed and corn barter economy. I believe that there are things that we can do to have a less credit-intensive model of growth, but they require things that go way beyond the remit of central banks and financial regulators. They have to do with both the role of real estate within our economy, but also, crucially, the role of inequality, because I think one of the things that is driving the increase in the credit intensity of growth is an inequality effect. If I can then link that to Ed's point, there was something Ed said which I completely and utterly agreed with, and totally agreed with, and I think he put it beautifully, which is in this area of if we believe that we can have credit cycles which are out of control and we want to constrain them, we cannot possibly ask the guys who are selling mortgages to take responsibility for it. As you put it, you can't expect them to go into a huddle and say, oh my God, Mrs. X wants this mortgage, seems to be right for her individually, but wow, there's this sort of, a fallacy of composition going on here, I've got to think this through. You've got to have that at the level of public policy, and we have got to constrain the credit cycle in public policy. You cannot do that, and that picks up what Axel says, through the inflation target. The inflation target, unlike what Vixell sought that provided we hit low inflation by having the nominal interest rate in line with the natural rate of interest, all would be well. I think what we've learned is inflation targeting is not sufficient. We need to pay attention to quantity aggregates, but we need to pay attention to them for a quite different reason from what we thought back in the 1970s and 80s. There was a time when we thought that we've got to pay attention to quantity aggregates on the liability side of the bank balance sheet, which is money, because it was a powerful forward indicator of inflation. In fact, we pretty soon realized that money is not a good forward indicator of inflation, but instead the credit aggregate, it's just the other side of the balance sheet, is a good forward indicator of future crisis and post-crisis recession. But what this does mean is I think we do have to, alongside addressing some of the fundamental drivers of the credit intensity of growth like inequality, we have to have an approach to central banking and macro-prudential regulation which is paying attention to the overall leverage and rate of growth of leverage and where it resides in the economy, and, as Joe said, by constraining it by some policy.
Good morning and season's greetings. Welcome to Deep Dive on Hedge TV. I have to tell you, I have not spoken with William White in a few years now. I can't believe how long it's been. But in the event you don't know who he is, let me tell you, he's the most straightforward and esteemed central banker I know. He's currently a senior fellow. You are, Bill, you are. He's currently a senior fellow at the C.D. Howe Institute. He's coming to us today from Ottawa, but he is also a veteran of the Bank of England, the Bank of Canada, the Bank of International Settlements, and the OECD. I could spend the rest of the hour, going through his CV. Let's not do that. Let's cut to the chase. In 2003, in Jackson Hole, and why don't you take us back to what you flagged at the time to Alan Greenspan, and what you feel was the fatal flaw in his philosophy that introduced really the modern era to the boom-bust cycle.
Well, that paper was written with my colleague Claudio Borio, and I have to say the thinking had been in the works for a long period of time. We had been very concerned about the policy of ultra easy money, in a sense. We'd felt for ages and ages that the willingness to live with very rapid buildup of credit and debt was something that would come back and haunt us. And so we wrote that paper in 2003 and presented it at Jackson Hole, and basically said, it's the middle of the Great Moderation. Everything looks great on the surface, but underneath the surface, there's all sorts of imbalances building up, and this could really lead to serious trouble going down the road. Now, of course, the response was overwhelmingly negative. People were very polite. Central bankers are always polite. But I think only Mike Musa, of all the people in the hall, poor Mike Musa is now departed, of course. He was the only one, I think, who said, there might be something in what Bill and Claudio are saying. But that was, as I say, that was 2003. That was almost 20 years ago. And frankly, I don't think a great deal of progress has been made since in changing the analytical framework that's used by most of the central banks, which tends to look upon the economy as being deterministic, understandable, and controllable. And the honest truth is that it's none of those things. I have become very fond of saying, really, in recent years, and I only discovered this literature after I left the bank, frankly, the Bank for International Settlements, that the fundamental problem is that the economy is a complex adaptive system. It's much like a forest than a machine. And the kind of rules that you need to govern it are totally different. And that battle, that analytical battle, the battle for the minds of people about how things work, that battle is still going on. And it hasn't been won on our side, and that's for sure.
So you bring up an interesting subject, and I actually want to get to non-bank versus conventional banking systems, because the debt that you described nearly 20 years ago, I mean, it's grown exponentially since, also in other pockets of the financial system. But before we go there, when I was at the Federal Reserve for 9 years or so, if I was to approach President Fisher at the time with a non-seasonally adjusted or a new type of more real-time data set, they were just dismissed out of hand. And there's something to be said for the fact that economies mature, grow, change, and as you said, adapt. So why can't central bankers change their framework? What is it that you're more than I am. What do they teach you in central banking school that says you have to stick to the same framework for the rest of your career?
Well, I don't think it's the central bankers so much as, in a way, the universities, because this stuff really does come out of the analytical frameworks that are common to most of the central bankers. As I've just described them, they really do come out of the universities. The kids are taught this at a very early age, and it just becomes so second nature. Talking about why people can't shift their beliefs is not in the realm of economics, it's in the realm of psychology. And I'm thinking back, I've used so many lines. One of them is Mark Twain, it ain't the things that you don't know that get you, it's the things that you know for sure.
Yep.
And even better, I think Cromwell to the Scottish synod. Brothers, I beg you in the bowels of Christ, think it possible you might be in error. And so getting people to shift their views is very, very hard. And the economists, it seems to be a harder deal than for most other disciplines.
I don't think people understand the implications of multiple balance sheet recessions as air comes out of these global residential real estate bubbles. And it was a balance sheet recession that was suffered in the United States, even though the Fed came riding to the rescue and quantitative easing and borrowing came back fairly quickly. But Bill, I don't think anybody has thought through the cumulativeness of multiple balance sheet recessions, whether you're talking about the Nordics or especially Canada, New Zealand, Australia. Do you think anybody's actually stopped and aggregated this risk?
Well, this is in keeping, of course, with the sort of complex adaptive system stuff, that in that kind of thinking, what's really important is not just the behavior of the individual agents, of which there are zillions, right, in a modern economy, zillions of consumers and millions of companies, et cetera, et cetera. It's the interactions between them. It's the feedback processes that are actually central to the final dynamic. And that's why in these systems, things can happen that might move you in one direction, or it might move you in a totally different direction, depending on the feedbacks. And that's why I would say at the moment, when we think about all of these interactions, I think they could just as easily end up in a serious deflation as they could end up in a serious inflation. And I could tell you a story about each one of those. But going back to your central point, the fact that you've got these sources of weakness, if you want to put it that way, balance sheet problems virtually everywhere, really is a source of concern. The point of the matter is that you do have all of these interactions. And when you look at the various major sectoral players, it does become worrisome. So you think about things, for example, like debt levels, okay, which were, I think, let's say 260% of GDP globally prior to the 290, I think it was, prior to the great financial crisis. Now there's something like 360. So it's not been a time of deleveraging. It's been a time of still more leveraging. Mm-hmm. The quality of that debt has been going down, the number of triple Bs, the covenant light loans. So, there you've got a huge problem. You look at prices of financial assets. So house prices, I mean, you mentioned Canada, Sweden, New Zealand, they're starting to take big hits. And the question is whether there's more to come, because the prices of the houses are so high relative to the usual metrics, whether it be rents or personal disposable income or whatever. And then you start thinking about market functioning, where we've had all of these we know there's something not quite right here. We've had these anomalies where arbitrage is no longer seeking to even them out. Mm-hmm. We've had flash crashes. We've had even the malfunctioning of the treasury market. Say the gilts, but the treasury market in September 2019, the spring of 2020. There are a lot of worries about whether going to continue to function well going forward. Then you've got the emerging markets. The list goes on and on of the individual flashpoints. But the worry in these complex systems that each of these elements of weakness, once something starts to go to trigger the process, then you get into a phrase that the environmentalists use all the time, which is a cascade of tipping points. So that you have these little sort of systems, that are subsystems of the systems, and something starts to go and then it triggers something someplace else, and then the whole thing cascades. And those are the kinds of worries that people should be having in the forefront of their minds, that it's not a question of always sort of dealing with crises ex post. Mm-hmm. It's an attempt to sort of see where the points of weakness are building up and trying to do something preventive. Because as our mummies always taught us, right, an ounce of prevention is worth a pound of cure.
And yet Alan Greenspan seems to have refuted that, and nobody's moved against that. At the same time, in the background, Bill, we've got, as of 2020, and I have to say that the Bank of International Settlements tends to be on the forefront of agents who are concerned about the non-banking sector. But as of the end of 2020, the non-bank sector was $220 trillion, and the conventional banking system globally was $180 trillion. I mean, these are largely unregulated entities, and I posit, I'd be curious what your views are, I posit that when you mention the word cascading, if you don't have price visibility in a larger portion of the global financial system that's more indebted, what are the implications when something goes wrong? It's in the visible world when the invisible is the catalyst.
Yeah, no, absolutely. And but one of the things that you have to point out, again, back to complex systems, they're always full of unintended consequences. Mm-hmm. You're doing things, you think you understand it, and then stuff's happening on the periphery. So when you think back to sort of Basel II and Basel III, I mean, quite rightly, the emphasis was put on strengthening the banking sector. And I think in large part that has been done in most countries. Although I have to say, Tom Hoenig had a piece yesterday in the FT that was a bit sobering about about capital and the big banks in the States. But when we brought in Basel II and Basel III, it was designed to sort of make the banks healthier. But the way I tend to think about these things is that I think the way we approach the regulatory side of things is as unsustainable as the way in which we've conducted monetary policy. And what I mean by that is the following. You start off by looking at the banks, and you say the banks are really important and they're subject to runs, okay? And that's very costly. So we have to set up safety nets to stop the runs and to make sure that things don't go really, really badly. And then you say, okay, so we're going to have all these safety nets. And then you say, oh my goodness me, safety nets, that means moral hazard, right? People will be behaving badly. So what are we going to do about that? And the answer is regulation. You bring in all these regulations. But the problem with regulation is it leads to evasion. And that's just exactly what we're talking about.
Exactly.
And this is what's totally legal stuff. And of course, in the modern world, really tendencies that are amplified by the technology, which really allows you to do stuff that you couldn't do 20 years ago. And so these people trying to avoid the regulation move into the secondary banking system. And in a way, that's what went wrong last time around in the great financial crisis. You know, remember all the worry about sort of the off-balance sheet stuff. And, okay, and having to be brought back onto balance sheet. And anyway, the Basel people sort of feel now, if you go to the Financial Stability Board stuff, that the problems that existed then, they've sorted. But they've just, you know, and they're fully aware of it. I mean, there was just a report from the FSB a few days ago saying that they really urgently had to look into the insurance companies and the non-bank financial institutions. And I think one of the particular things that they're worried about is runs on mutual funds and things like that, where they promise same-day liquidity, and yet the assets that they're holding are not liquid. And we saw this with the BlackRock stuff here just recently. So there is this enormous system out there now of which we don't know a very great deal, and it is worrisome.
And they play by
it is the unintended consequence of what we did.
Absolutely. I mean, you visibly saw the brain drain after regulations tightened up on the conventional banking side. Everybody said, well, my gosh, I can't rob and pillage like I did before, so I'm just going to leave this system and go where I'm not going to be regulated, go where, and by the way, I'm going to sell it to all the public pensions as being a way to diversify. And I'm going to take liquidity out of the equation such that it'll take 2 or 3 or 4 quarters before anybody has to mark anything to market. And yet here we sit today.
Well, I think Daniela, and I just wrote a piece actually for the C.D. Howe Institute on this, the short piece. But the point that I was making in that piece, and it plays into what you just said, is that there's a lot of forces coming down the line that I would classify as sort of negative supply side shocks. And it's not a simple story, and it's not a very what's the word? It's not one that makes you sleep well at night. The list is really quite long. You know, you've got all of the sort of the pre-COVID stuff. I think there's a lot of misallocated capital that people sort of, or economists tend to say is productive or will be productive, and it won't be because the money's basically being wasted. I won't give you the names of companies, but you know the kind of companies I'm talking about. We've had the implications of the pandemic itself. More and more of long COVID and people who've taken early retirement. The complications of the COVID policy in China, where the supply chain is no longer reliable the way it was. Then you've got the demographics, and you're spot on that, where the labor supply is down all over the world. So the baby boomers are gone, and the China one-child policy, and whatever. Then you look at climate change, which I think has been underestimated as a negative supply-side shock by the economists. Certainly not in the models. So if you're thinking about adaptation, you're thinking about mitigation, and then the actual losses themselves, the ports that get blown away and all that stuff. There's a lot of negative supply side shocks coming down the road. And whereas we tend to think about the 1970s as, we had the energy price shock, in a certain sense, it was sort of certainly not entirely, but there was an element of sort of self-resolution. in the sense that if you paid more money for oil and it went sort of offshore, there was less money at home to buy other stuff. So it's sort of, there was a tempering effect there. But when you look at many of the things that I've just spoken about, what they seem to me to call for is more spending, not less spending. So on the demographic side, I mean, Charles Goodhart and his colleague Prahan wrote a whole book, which they call The Great Demographic Reversal. And one of the central points that they make is that you got to think about old retired folk, okay, not just as consumers, but as people who are no longer producers.
Right.
So you've got a sort of an inward shift in the supply function. And at the same time, they would contend, and I agree, that corporations that find themselves short of workers or expensive workers will then turn to the automation that they put off for a long period of time. We know in many, many companies that they're way behind on this front. You know, the spread from the high productive companies to the low productive companies has been the gap is huge. Lots of room then, but that's more investment, not less. You think about climate change, and if it's adaptation or mitigation, it's going to be enormously expensive. Replacing all of those ports that get wiped out can be enormously expensive. So what I fear going forward is that we will have a world in which the supply is sort of not going down, but sort of rising less rapidly than it has traditionally, whereas the needs for investment are going to be that much stronger. And you don't need a degree in rocket science to sort of say that if the supply is restricted, but you still have more need for demand on the investment side, the only place you can get the resources, this is Keynes' How to Pay for the War, is from lesser consumption going forward. And that is going to be an enormously difficult story to sell.
Oh,
and
God.
You can see,
I mean, look at what's happened. Look at what happened. Look at there's less than there's less than $500 billion of savings in dollars as of the end of October in the United States. I mean, look at what American consumers spent that was given to them by the government and then spent down in terms of their rainy day funds and then levered up in terms of their credit card. The idea that consumption will have to be sacrificed, this is you're talking heretical. Somebody's going to hang you, Bill.
I know, and whether it's as I didn't put it in the CD Howe paper, but elsewhere, as you sort of try to sell this reality, you got to sell it to the voters on the basis of what is it, Tina? There is no alternative. And when you think about the climate thing, and I'm a believer 100% in this stuff, this is almost existential. What we're saying effectively here with climate is that the social rate of return for more investment in mitigation is enormously high. That's the underlying economic reality. You want to put it in the context of the models. And so there really ought to be a great willingness to sacrifice consumption in the interest of a sustained existence going forward. But it's going to be a very, very hard sell. And of course, one of the things that you mentioned earlier, of course, is debt and the overhang of debt. And I do think that one of the components sort of moving forward would be a much more vigorous approach to the reality of the overhang of debt that won't be serviced and won't be repaid and should be written off in an orderly and a structured way. And we're not well set up to do that. I mean, the BIS, the IMF, the OECD, the G30, they've all been calling for years for improvements to judicial administrative procedures for write-offs. I think as they'd say, the fer de lance, the head of the spear for this is probably going to be the debt of poor countries. The IMF is already, I think, 60% of low-income countries are either in debt distress or will be. That needs to be dealt with in an orderly way before it, spreads out in a disorderly way.
Well, I talk about the manifestation of the Fed put, cryptocurrency, SPACs, outright fraud. things that we're seeing, unfortunately, in the headlines, and we can't really see much else behind these headlines. It's all anybody wants to talk about. I was around the markets in 2000. I was on Wall Street back then. I mean, we knew it was an internet bubble, and we knew that housing was a bubble, and so did you. You identified the subprime crisis very early on. But this still feels different. It feels bigger.
Yeah, well, it is bigger because, as I said before, that these systems are sort of path dependent, and so you start from where you are. Okay, we've had a bubble and a bust, and the debt levels have built up, and the other imbalances in the economy have built up, and now we've got another one. Bubble and bust. Again, it's been recurrent now for 30 years. And each time the problems are getting bigger and bigger. And so from a logical perspective, you're anticipating that at a certain point, it'll get bigger still. And going back to something we said earlier, that the anticipation, every time we had one of these bubbles and a bust, you mitigated the downside by ultra easy monetary policy, and more recently, of course, fiscal expansion. But what you know logically is that if each time you do it, you are aggravating the underlying problems. You know that although each time you've pulled the iron out of the fire, you know that eventually a time will come when it won't be possible. And I think it's perfectly natural that people like you and me and many others should be, as we approach a potential problem emerging, a recession and what might go along with it, to worry that the side effects or the magnitude and or the duration of that downturn might be bigger than we've thus come to expect. One, because the underlying problems have now accumulated, and two, because the capacity of the macro authorities to lean against it has become attenuated. So it's a kind of two, it's the meat in the sandwich.
Right. And
that's the reason why I think people have got...
And then when, it's so circular, because then you end up having to create more debt to bail out a system because the downturn is more violent. And so here, I want to ask...
This is where you end up. I mean, you can tell a story when none of this stuff works, okay, which is a kind of deflation story, where eventually... it's debt deflation of the Irving Fisher type, where eventually you get into a big debt problem and the prices start to go down and the debt becomes still less serviceable because the prices, your revenues are going down, and so it accumulates. But you can also tell a story of the governments basically saying, as Milton Friedman would say, in the end, all inflations are monetary phenomena, that if you spend enough and print enough, that eventually you will get the prices to turn around. But the problem is that when you do that, which is a kind of Latin American solution, the question is whether you can control the process. As I said before, in these systems, it's the process, it's the dynamic interactions and the positive feedback effects that are so important. And the question then becomes, I've turned it around, but can I control it?
Right.
And
I think we've just watched that experiment live. I mean, we bypassed the banking system here in the United States. We gave money directly to the people. There was nobody assessing creditworthiness. We just handed money to the people. And meanwhile, back at the Fed, they're going average inflation targeting, and I'm going, wait a minute, we're well past average. You've lost control. So we've only got a few more minutes left. I want to end on a positive note. We've got a question. And actually, this would be a question for me as well, because my oldest is interested in economics. How do we hatch a new generation of economists who are more practical, pragmatic, and understand the psychology? I mean, we have to go to the root, as you've started off by saying, in academics. How do we get there?
Well, if you go back to, again, I like to go back to Keynes because his prose was so wonderful. But there was something that I think it was the obituary of Marshall, an economic journal, and he talks about the attributes of an economist. And, you know, he has to be sort of a mathematician, a statistician, a philosopher, a statesman, and the list just sort of goes on and on, you know, because in a way the economics brings together a psychologist brings together all of these different things. With that as background, you may recall that George Soros, when he set up INET, you know, the Institute for New Economic Thinking back in 2010, a primary focus of INET was supposed to be, and indeed has been, coming up with a different curriculum, one that George thought was more relevant to the real world. And I think Nancy Carlin has actually done such a thing, and the curriculum is up on the net and it's available to anybody who wants to look at it. But another even more interesting aspect is that the students themselves, and I think this started at my old alma mater, I think at the University of Manchester, basically revolted against the curriculum with the suggestion that it was totally unrealistic and unfit for purpose. I guess this is primarily the macro stuff.
Mm-hmm.
And now this movement has spread all around the world. And there's a book, shucks, I wish I could remember the title of it, Sam Dominguez, who is much involved in this. But there's a movement of students who are out there, and they've constructed their own curriculum as well. So I think there's a growing recognition that the fundamental problem here, almost from the start, has not been bad execution. It's been a bad analytical framework.
Mm-hmm.
That it's the way we think about things, that we need a kind of analytical revolution. And in my case, that I say, I think the starting point would be to say the economy is a complex adaptive system. And that just the simple embrace of that, and I mean, I've written about this too, the simple embrace of that concept leads you to policies that are vastly different from the ones that we followed. So item number one about these systems is they always break down, okay, according to a power law. Essentially, big breakdowns happen very infrequently, smaller breakdowns quite frequently, but they always break down. So what's the lesson? The lesson is be prepared.
Absolutely.
We were not prepared for the great financial crisis, for
And
the
adapt.
crisis itself. You know, and it happened.
Adapt as
so
you
lesson
go.
number one, be prepared. Lesson number two, you don't know much about how things work. So maximizing is beyond your capacities. You can't take the last dollar of GDP out. What policy should be directed to is avoiding truly bad outcomes, okay? And there we can get enough of a sense of what's going wrong to try to put it right. So it's those kinds of thoughts that actually, just from a new way of thinking, okay, a new starting point of your thinking, can lead you to some very different policy conclusions. And I think the students are right, and guys like George Soros and others who worry about what the young people are being taught, they're right too. We just need a new way of thinking about these things.
Well, it
But
sounds
before
like
we get to
it
that-
sounds like you're advocating for bringing back the business cycle, which is extraordinary.
Well, I'm advocating for bringing back a recognition of the fact that there are more cycles than business cycles. There's the financial cycle, and that probably in the modern world, the financial cycle, the credit cycle, is more important than the inventory cycles that we used to worry about in the past. That's not to say they're not important. It's to say that there's other things that have to be taken into account as well. It's complex.
Well, we will leave it on that note. I know you've got a hard
conversations here, and our first two guests are two premier economists, geopolitical economists. They are Radhika Desai, who is a friend of the show and former guest, as well as Michael Hudson, also friend of the show, also prior guest. They also are doing a podcast together on geopolitical economy report bi-weekly, and you can catch their books in the links in the description because they are also prolific authors on the very questions we will speak about today. Good afternoon, Radhika. Good afternoon, Michael. Thanks for joining me.
Thanks very much, Danny. Great to be here.
Great, great. So I wanted to just kick off and ask you to, if you could give some reflections on the economic impact of the Ukraine proxy war, because, you know, I think this is not talked about so often. Much has been made about, of course, things like the energy crisis, things like Ukraine's economic situation, but there hasn't been really in-depth analysis, at least from the perspective of where you two may come from with this question. So what do you feel like are the most important economic impacts of the Ukraine proxy war, and what has changed? And maybe we can start with Michael, and then Radhika, you can follow up right after.
Well, the whole purpose of the war is economic, but it's not economic just about Ukraine and the winners and losers of the United States and Europe. President Biden has said this is a 10 or a 20-year war, and it's for what kind of economy is the world going to have? Is it going to be a finance-based, neoliberal, rentier economy centered in the United States, with the United States controlling all of the monopoly rents for oil, for raw materials, for technology, for computer information, for pharmaceuticals, or will other countries have a chance to be independent? And Ukraine is just sort of the first joust in this long war, and it's over the economy. Everything that's happening right now is just sort of a squiggle over the really big picture, which is how the world is going to be structured economically.
Hold on,
absolutely. I think I'd just like to add that, you know, if you look at the biggest picture, basically the world is dividing, exactly as Michael says, into two. And what's really interesting now compared to, you know, if you look back at the centuries-long dominance of the West, which basically is coterminous with the rise of capitalism, in a certain sense, you're beginning to see its demise. Because if you look at a map of the world, of all the countries in the world that are imposing sanctions on Russia, that are supplying arms to Ukraine, etc., what you see is essentially the core of world capitalism as it was in 1914, with a few little additions, very tiny, very insignificant, not very economically important. Whereas the entire rest of the world is going in the other direction, and the divide between this West and the rest is growing precisely in the ways that Michael is saying, because the West is basically has been in a long-term trend of decline, but the Western leaders have continued to pursue the policies that are responsible for the decline, because even though they are not good for the economy, they are great for the monopoly, financialized corporations of the West, which, as Michael says, have become more and more reliant on rentier income, on rent and interest, rather than profits from production. So that's really the key. So it is dividing because basically, and this is happening even though so many countries in the rest of the world, in the third world, etc., are not doing so well, thanks to the pandemic crisis, thanks to the economic difficulties created by the Ukraine war. But nevertheless, the one thing that is happening is that even though they may not be doing well, what they are beginning to realize is that the West has very little to offer them. And meanwhile, particularly China, and of course, given the energy situation, Russia may have a lot more to offer them, and they are beginning to exercise their national sovereignty and making choices which are actually not very favorable to continuing Western dominance.
Well, that's the whole point. The war, in terms of the long perspective, is how does the United States prevent other countries from developing their own sovereignty and for becoming independent of the reliance on the United States for oil, for technology, for credit, for money, for using the dollar? And how does the U.S. prevent them? And Ukraine is sort of the opening statement saying, just as we're fighting to the last Ukrainian, if anybody else wants to go it alone, we can fight to the last Taiwanese, the last Japanese. Who wants to be our ally?
Yeah, well, let's bring in sanctions here because early on after Russia launched its special military operation, there was a flurry, and they're still piling on the sanctions as we speak. But the EU and the United States especially began to pile on sanctions onto Russia, made Russia the most sanctioned country in the world. And there was a lot made about the impact of these sanctions, especially on energy and the trade of energy, especially when it comes to Europe, since Europe depends a lot on Russian gas and Russian oil. What has been the impact of these sanctions? And can you talk about this maybe historically over the course of the last year? Because it felt like there's been waves of various interpretations of how it would go. There was a lot of doomsday about it. There was a lot of kind of like Europe was going to be in big trouble. It seems like there's been just a lot of various shifts in how this has gone for Europe and how this has gone for the world. What is your take on the impact of the sanctions, such a big economic weapon, a part of this war?
Well, we'd have to discuss sanctions on a region-by-region basis. Obviously, the United States has become the big winner in all of this, in the sense that the sanctions have turned Western Europe into a dependency. Western Europe is now an economic colony. It's dependent on the United States for oil and gas and for fertilizer, that is so much more expensive than it was available in Russia, that German and French and Italian industry are saying, well, in order to remain in business, we have to move to the United States. They're not talking about moving to Russia or moving to other places, but the United States has, because of the sanctions, has solidified its economic stranglehold on Europe. The big winner of the sanctions, next to the U.S., is of course Russia, because Russia, despite the fact that President Putin has wanted to break away from the neoliberal philosophy, he wasn't willing to impose protective tariffs and to really protect Russian agriculture, Russian industry, Russian manufacturing. The sanctioning basically has said, well, we want to help you develop, Russia, and because you won't protect your agriculture like the common agricultural policy protected the European community, we're going to sanction you and we're going to force you to become independent, grow your own food. We're going to force you to produce everything that you were dependent on the West before, so that you won't need the West anymore, so that you can work with China and Iran and the rest of the world. We're really helping you to become independent from all of this. We'll take Europe. You won't have Europe anymore, but Europe isn't going to count for very much because it's sort of a dead zone now. So basically, there's been this this shift of Russia eastward, and of course what's up for grabs. And I think what we should talk about in this show is what about the southern countries, the South America, Africa, the rest of Asia, that's had its energy prices go up so far, its food prices go up so much, its fertilizer prices go up so much, and the US dollar in which all of these goods are priced go up so much. What are they going to do? Are they going to essentially realize that we're going to have to survive only by not repaying the foreign debt, only by protecting our own agriculture, or are they going to succumb? That's the real aim of the war in Ukraine. It's not fought over Ukraine. It's fought over Africa, South America, and East Asia.
No, there's a lot of really good points there, Michael, and I would add a few things. I mean, if you were to just say one word about the sanctions, which are imposed by the West, I would say that the word that simply describes what has happened as a result of sanctions is boomerang. The sanctions were advertised as, they're going to lay waste the Russian economy. It's going to make the basket case. The big, nuclear option of just freezing Russia's reserves is going to bring Russia to its knees. None of this has happened. And I think this is really interesting to sit back and observe why that is so. Because, if you look back at the history of sanctions, which goes back to the early days of the First World War, what you find is that basically the application of sanctions sanctions was a attempt to bring to Europe, and essentially an attempt to use everywhere else measures that had been used by imperial countries against their colonies to bring them to submission. But the fact of the matter is that we have come a long way from that world, and even the relatively weaker economies of the world are not so easily damaged without inflicting damage on yourself. So I would say that basically and of course, Russia is not at all a weak economy. Russia is not only a strong economy, but remember, given that the West has been imposing sanctions on Russia at least since 2014, the Russians have become used to handling sanctions. They have become used to responding to sanctions by finding alternatives and by strengthening domestic production. So one really good example of this is that after the agricultural sanctions imposed on Russia in 2014 and later, basically Russian agriculture has turned right around. These sanctions have made Russia into a major agricultural exporter. Excuse me. So I would say that I agree, of course, with Michael, and I think Michael's done a great job of explaining this, how much Europe is hurting. But the United States is also hurting. The inflation in the United States is directly connected with the disruption of supply chains, which has to do with sanctions and so on and so forth. And generally speaking, you see, the United States tried to create a world in which it could dominate, imposing on it various so-called globalization rules. But what's happening now is that China, and particularly China, but a few other countries as well, are basically beating the US at its own game. So the United States is now having to disrupt those rules and to impose sanctions and engage in protectionism. So I would say the US is also a loser. I would also say one other thing about Europe, a couple of other things about Europe. Europe, to this day, Europe and various European countries are applying sanctions selectively in ways that make a big bang, but the buck is small, so to speak. So they don't lose that much. So, for example, today's headline, the Europeans still can't decide what sort of oil price cap to put on Russian oil, because each country has different considerations and so on. But so they're applying sanctions selectively. But yes, Europe is hurting. They have been helped a great deal by a mild winter. Everybody thought if the winter is bad, Europe is going to have a really tough time. But there's a mild winter, but mild winter is not going to save Europe for a long time, because these sanctions have forced Europe to buy more expensive gas. Right now, their coffers are full, their gas reserves are full, but a lot of people are saying that come next winter, that will be the real test of all this. Will they actually be able to continue with these, cooperating with them, even appearing to cooperate with American sanctions, as they seem to be doing right now? I would say, and remember also, all the major European countries know who blew up the Nord Stream pipeline. That the United States is so ruthless in its efforts to achieve the goals that Michael had just outlined, that they are willing to go as far as actually blow up a friendly country's infrastructure. So that's what you're looking at. And one final thing I'll say, in recent months, I think it's a couple of months since Merkel's interview took place, and everybody is telling us that Merkel said, "Oh, look at that! Merkel even said that we only engaged in the Minsk Accords in order to buy time for Ukrainians." I have read the German version of that interview. Merkel does not say that. What Merkel says is, yes, in retrospect, signing those accords gave Ukraine time, which is a very different statement from saying that we intended to do this, to fool Russia all along. Because if that had been the case, why would Merkel have engaged in Nord Stream 1, Nord Stream 2, various other measures to make friendly relations with Russia? Remember, German-Russian, the desire to connect Germany to lands eastward, to Eastern Europe and Russia, goes back at least a century, if not more. Just the other day, I was reading about the so-called Dreikaiserbund, which is the German, the Austrian, and the Austro-Hungarian and the Russian czars or emperors would create a sort of alliance, which would actually make Germany unbeatable, because Germany has all this technology, plus you have all these resources of these big parts of the world. So I don't think that these divisions are going to remain underwater for long. They are going to surface. So we have gone on for a bit, but it's really important to remember that. I think in the coming year, the big headlines that everybody should be looking for is once the disruption of the much trumpeted unity of the West.
Yeah. Well, all of those are really good points, and I guess, continuing on with this discussion of sanctions, it seems like you both outlined winners and losers, and also kind of the dialectic between the two. You can both be a winner and you can be a loser. The United States seemingly fitting that description. But I wanted to ask you, what made Europe and the United States so confident about this form of economic warfare against Russia? Because we know there's 20 plus, 30 plus countries around the world that experience some form of sanctions imposed on them by the US, the EU, or some attendant institution connected to them. But at the same time, it seems like there was so much confidence that Russia was going to fall, that its economy would become a basket case, and therefore that would greatly facilitate the US's and the EU's goals when it came to this proxy war in Ukraine, which was to destabilize Russia. What happened? Why did that not happen? You touched a little bit on Radhika, but maybe Michael, if you want to take that question, and then any other further reflections on that.
How on earth can we explain how Americans or anyone else make a mistake about viewing the future? We can't explain the logic behind their mistake. There's no particular logic behind it. The fact is, they didn't care about Russia. This isn't about Russia. They didn't care whether Russia would recover. I think they've sat down in Washington. They realize that there's no way that they can prevent what is happening now. The Russia, China, Iran, India access from developing, and they've decided what we're going to do is a holding operation. What can we hold? We can hold on to Europe. The one of economic effect of the war in Ukraine is to completely disarm Europe. Europe has no more tanks, no more rifles, no more ammunition. It's a huge market now for American arms if the United States can continue to keep the current European political leaders in power. The United States has solidified its hold on Europe, and it had hoped that by the sanctions would put such an economic squeeze on debtor countries, on Latin America, Africa, and South Asia, that they would be forced into higher reliance on the dollar. So it's sort of a myth to think, yes, they say we'll break up Europe. That's simply political talk to sell it in the United States. I should have said that they thought they'd break up Russia. They keep talking about dividing Russia into 5 or 6 countries, but that's so unrealistic that you have to almost look at that as a distracting patter talk. They're looking at what they can absolutely hold on, and they're trying to hold on to the world outside of Russia, not defeat Russia itself. It's a fight over how America can control and essentially dominate its allies, not its non-allies.
Yeah, I'd actually like to add a couple of points to that. I think one of the things that I'm always just struck by, we've now been watching this conflict for nearly a year. And what I'm just amazed at is the extent to which the United States is, you talked about US confidence, but I think US confidence is itself a bit of a con. What do I mean by that? What I mean by that is that, first of all, different parts of the US state are pulling in different directions. Different parts of the Western Alliance are pulling in different directions. And even so, for example, obviously there are, whatever confidence there may be that we may be looking at is basically a result of the pronouncements made by those who in whose material interest, if you go by the follow the money principle, in whose material interest the war is. So they, of course, want to sound totally confident that yes, the war can be won, etc. And of course, as you know, recently there has been a Rand Corporation report, which Rand Corporation being very close to the US administration, etc., which has been interpreted in two very different ways. You know, the warmongers say the Rand Corporation says we have to continue this war and intensify it and prolong it and so on, and others are saying it means something completely different. So I think that what we have to realize is that the US is trying to achieve a whole range of conflicting objectives. I think one is obviously to try and retain its purchase on world affairs, try and retain its dominance on world affairs. It's not succeeding, but that's what the effort is about. But at the same time, the US is also trying to, it is also sort of trying to profit. So the military industrial complex is profiting. It's making money hand over fist, not only right now, but we should watch the coming US budget, because basically it looks as though the Pentagon and associated interests are going to use the Ukraine war as a way of essentially increasing the contracts being given to the 5 major US corporations. Over the 20 years or 30 years since the end of the Cold War, what used to be dozens and dozens of military suppliers have become condensed into 5. And you can imagine, if there are only 5, they find it very easy to talk to the American government. So they are making money. They are going to get long-term contracts under the guise of, and obviously people like them want to prolong the Ukraine war. But there are also a whole bunch of other things. The United States is also, for example, we are being told that a lot of the United States is aiding Ukraine. One of the things, and in order to aid Ukraine, the United States has passed a new version of the Lend-Lease Act through which it had aided European countries during the First World War. But if you look more closely at the Lend-Lease Act, what you see very clearly is the opposite of that. Basically, most people, when they hear the word aid, they think that the United States is giving money to Ukraine. It's not giving money to Ukraine. If you look at this text of the 2022 Lend-Lease Act that was passed and look at Clause 3, it says very clearly, there's a number 3 which says condition. Yeah, if you read that, it says very simply, any loan or lease of the of defense articles to the government of Ukraine under paragraph 1 shall be subject to all applicable laws concerning the return of and reimbursement and repayment for defense articles loaned or leased to foreign governments. Ukraine is going to have to pay for this. Now, let me also tell you one other thing. In any such situation, as was the case in the First and Second World Wars, so it is now, the United States is profiting from wars very far away. The United States is also sending 2 kinds of weapons. Number one, obsolete weapons that it needs to get rid of anyway. So this way, it gets to make money out of assets that it would have had to write off otherwise. Secondly, it wants to send those weapons which its military industrial complex corporations want to have tested in battle conditions. So in all of these ways, the United States, under the rhetoric of aid, is actually using Ukraine. I don't think it cares a farthing about what happens to Ukrainians, as Michael has also said and reminded us, and as John Mearsheimer keeps saying, the Americans want to fight the Ukraine war, the war against Russia, to the last Ukrainian. So I think these sorts of things should give us an idea that different parts of the US administration are pulling in different directions. As always, there are many pigs feeding at the trough, and they are all getting their bit. But in the meantime, the trough is Ukraine. They are emptying Ukraine.
Well, let's take that to the next step. You mentioned the effect of Lend-Lease, especially on England. In the Second World War, the Lend-Lease made England pay by essentially emptying out the sterling area reserves that India and other raw materials producers had put in London during the war. All this money that was accumulated by the British colonies ended up opening up the sterling area to the United States, saying these countries can spend their money anywhere, not only in England. So there was a huge demand for the United States, and essentially the Lend-Lease broke the British Empire. Well, let's look at what's happening in Ukraine. How could Ukraine possibly repay more than $10 of the debt that it owes for the arms and others? Well, the idea is that obviously there's a reason that in the last couple of weeks you've had Blackstone going back and forth to Ukraine. You've had Blinken going around. You've had George Soros talking. In the last, I guess, year of the war, Ukraine has sold its farmland, its mineral resources. It's sold almost all of its raw materials and agriculture to American firms. Now, the problem is, how can a puppet government such as Zelensky actually have the authority to sell? You've had in the last week hilarious talks, suggestions, even in the Washington Post, by supposed leaks saying that, well, the United States State Department is willing to talk to Russia to make a settlement on all of this. And maybe we're even willing to give Russia the Luhansk and the Donetsk regions. I can imagine what the discussion would be between the State Department and Russia. Mr. Blinken would say, well, Russia, you can have these regions. It's okay if they're part of Russia now, but you have to respect the international private property rules, and you have to realize that the titanium resources in this region that we need for our airlines, the agricultural land that's so fertile that we need to control the export trade, that your oil and gas and all of your minerals have really been bought up by the Americans from Mr. Zelensky's regime. Are you willing to obey the rules-based order that says we stole it fair and square? Well, obviously, Russia's not going to do this, and it's only a ploy to pretend to Europe, to pretend to the world that, yes, the United States is willing to give Luhansk and the other Donetsk to Russia. Of course, it's even willing to let it keep Crimea, but Crimea, as long as the United States private sector owns most of this property, which, of course, is inconceivable in principle.
You know, that what Michael just said, it just reminds me that, you know, people don't understand what imperialism is really about. Because you see, and also what control of territory is about. Let me just explain a little. You know, Russia is generally portrayed in the Western media as sort of attack. You know, it's taking over Ukraine, it's expansionist, it's imperialist, etc. But what Russia is trying to do is defend its national community. That's what it's trying to do. And those members of its national community, which are part of Ukraine, it tried through Minsk Accords, Minsk I, Minsk II, to secure their interests within Ukraine. It was not insisting that it wants to, but since this, you know, that it wants to, you know, incorporate them into Russia. But since this has proved impossible, they are now doing the next best thing, which is to incorporate them in Russia and consolidate that national community. But the United States, which is the real imperialist, it doesn't care about controlling territory. In fact, controlling territory is a bit of a headache. Like, you know, you have to take responsibility for people. So what it actually wants is, as Michael says, that other countries should simply do Russia's bidding and deal with the consequences, the political consequences of that, repress, for example, by repressing their national population, because they are bound to oppose it, because the policies that the United States wants these countries to impose are not in the interest of ordinary people of any country. Quite frankly, they're not even in the interest of ordinary Americans, as ordinary Americans are finding out with all these demands, you know, which are basically, you know, why are we sending so many billions to Ukraine? Of course, the United States is not sending billions to Ukraine. It's indebting the Ukrainians, but it is certainly refusing to address domestic problems, including those of shocking and scandalous levels of poverty and so on. But anyway, you know, so that's the first thing I wanted to say, which is this contrast between running a national economy, which is kind of what Russia is doing to some, you know, to significant extent, and essentially running an imperial economy, which is at the expense of your of your own people as well as the people of the rest of the world. But now I just want to, you know, when we talk about the political economy of the Ukraine war, one can talk about a lot of things, as we have indeed. We've talked about the effects on the United States, on Russia, on Europe, on the rest of the world, on China and Russia relations, and so many different things. But one really important piece of this puzzle is what's going on domestically in Ukraine. And there I would say that, as we know, since the end of the Soviet Union, of course, there was shock therapy and privatizations and so on. But you also have to remember that all these things, as these things unfolded, and particularly as people realized what people were actually disillusioned by the end of the Soviet Union and so on, because one thing people forget is that people of the Soviet Union did not want the end of the Soviet Union. In early 1991, at the end of which year the Soviet Union was dissolved, there was a poll conducted in the Soviet Union, and 80% of the people voted to retain the Soviet Union. They did not want its breakup. So that's important to remember. So Ukrainians have also fought back against privatization and neoliberalism and shock therapy and so on. And one very important consequence of this, for example, of this fight back, was to stop the sale of land. You couldn't buy land in Ukraine. Foreigners couldn't buy land in Ukraine. But in 2021, precisely around the time when the Americans started stepping up their attention to Ukraine and so on, this law was repealed. And since then, you can buy land. And what's really shocking is that in the context of the war, where you might think that, normally when nations fight wars, they actually pass solidaristic legislation, to help the weakest, rationing, to tax the strongest and so on, so that the nation is united, it's more equal. This is exactly, in fact, in Britain, for example, this went so far that actually longevity increased during the war. When Britain was losing lives in the war, longevity increased because people were getting enough to eat. So this solidarity, if you're looking at Ukraine and looking for this sort of solidarity, you don't find it. In fact, the war is being used as an excuse to do the opposite. All sorts of extremely anti-labor legislation has been passed. The privatization legislation has been passed. And of course, amid all this, opposition has been silenced. Zelensky has banned a number of the left-wing parties. And so, and remember also that this is in a context where Ukraine was already the second, next to Moldova, the second poorest nation in Europe. So now what's happening is, in the name of de-Sovietization, there is even more privatization going on. And in the design of this privatization, what I read, for example, in an article in Open Democracy, is that some of the most recent legislation was, and this is just one little instance, right? It was developed and designed by a Ukrainian NGO, which calls itself, listen to this, the Office of Simple Solutions and Results. And it is set up by the former Georgian president, Mikhail Saakashvili, along with Ukrainian employers associations and, get this, a USAID program. So you can see all, and if you actually read the whole article, NGOs, which basically represent the interests of big multinationals abroad who want a piece of Ukraine, they are helping design these legislations, scrapping labor protections, increasing working hours, increasing privatization, including of land, etc. It's really horrific.
So you've described Ukraine as a dress rehearsal for what the United States would like to promote all over the rest of the world.
Yes.
Absolutely. Absolutely. So, for example, in the middle of the war, Zelensky, and I'm reading one of the articles that I found, Zelensky announced his government plans to launch large-scale privatizations beginning September 1. Subsequently, on 28 July, the Ukrainian parliament adopted a draft law number 7451 on amendments to the law in Ukraine on the privatization of state and communal property, which is intended to simplify the privatization process. It will make large-scale privatizations at online auctions, shortening the terms of conducting privatization auctions. And then we are told later on that all of this is very good because it will help Municipalities and local governments make up for the revenue shortfall caused by the war. Go figure. So now, if you go back, follow the money. How is the war being financed and funded? Privatizations have now become essentially a way, allegedly, of financing this war, which is destroying Ukraine in the name of saving it. The hypocrisy just makes me cry sometimes.
Yeah, yeah, and I mean those are those are great points. I think you both outlined just how much this proxy wars affected Ukraine, and that's not talked about so much. Sometimes you get in the media that the economy contracted by what was it, a third. About you get this information haphazardly about just how much foreign aid, U.S. in particular, aid has been so important now to the government's entire budget. I mean, it is just astounding. And you outlined, Radhika, quite clearly in that Lend-Lease Act that these are debts that will be paid back, or at least if they're not paid back, there will be heavy costs to Ukraine in the future from here on out. And of course, right now, there are huge consequences. Maybe we can segue to a topic that you two have been covering a lot lately, which is this kind of broader macroeconomic situation with inflation, but in particular the US dollar, because one thing I've noticed over the course of the last year is that more and more countries are being very vocal and even starting to put together the foundations for de-dollarization. So while the US dollar has indeed strengthened off the backs of Europe, there's also been a lot of talks, even from countries like Saudi Arabia, trading in RMB with China around the oil trade between the two countries. You also have BRICS expanding over the course of the last year, including countries not only Saudi Arabia having interest, but Turkey, Algeria, Argentina, Iran. I'm wondering what you make of this trend toward de-dollarization. Maybe, Michael, you can begin when it comes to how the Ukraine proxy war has affected it.
Well, the sanction that we did not mention, of course, was the Americas' grabbing of all of Russia's foreign exchange dollar holdings in the United States and Europe. Whatever Russia held or Russian agencies held in Europe or the United States was simply confiscated. And the American State Department said, we are going to give that to Ukraine. Well, of course, you give it to Ukraine to do what? To pay back the United States for all of the foreign aid that we've given it and letting them fight our proxy war. So what this has done in conjunction with the Bank of England's seizure of Venezuela's gold stock is letting every country know, you've seen what we've done to Ukraine. If you get us angry at you, if you don't play by our rules-based order, then we can simply grab your money. We grabbed Iran's money right after the Shah was overthrown and made it a financial pariah. If you continue to use the US dollar, we're holding you hostage. We're holding the dollars hostage. So this has led every country outside of the United States and Western Europe to say, how do we handle our trade without using the dollar? Well, obviously, the very first attempts are currency swaps. Let's do trade in our own currencies. And then they're trying to create some means of mutual obligations for deficits in the trade between, let's say, the Near East, South Asia, Africa, and Latin America. Well, the problem is, if you de-dollarize, how can you create a currency to take its place? You can't do it through the International Monetary Fund because the United States has veto power in it, and the Monetary Fund is really a branch of the U.S. State Department and military. That's why the Monetary Fund is given grants to Ukraine. But one of the nice things about the IMF new loans to Ukraine is the IMF said, we don't have to obey our rules at all if we're doing something that the United States wants. Our rules say that we cannot make a loan to a country in a war. But Ukraine is different. We can make a loan to Ukraine. Our our other rule, which is what led to much of our staff resigning in the Argentine financial crisis a few decades ago, was we cannot make a loan to a country that can't afford to pay back. Well, obviously, Ukraine is not going to be in any position at all to pay back. This double standard of the Ukraine enables all of the countries who owe the IMF money, Latin America, Argentina, Brazil, South Asia, to say, well, now that you've made it clear that the IMF is simply a branch of the United States Treasury, and we can't afford to pay you and still afford to import our oil and gas, now that you've imposed sanctions that have raised the prices, now that we can't afford to pay the dollar debts, now that the dollar has raised its interest rates and gone way up against global South currencies. So in order to survive, we're going to make trade among ourselves, and we can get the money to finance our trade among themselves by not paying the dollar debts. Well, the United States is going to respond by saying, if you go to other means of payments besides the dollar, then we will simply sanction you like we've sanctioned Russia, and we will cut you off from world trade. So that in order to de-dollarize, given the military and the political maneuvering that the United States is going to do, they have to become commercially independent of the United States and Western Europe for almost all of their imports, their food, their cars, their telephones, their electronics, everything that they basically need. They have to be able to make sure that there is no choke point in their trade of dependency on the United States that enables the United States to say, we can use this choke point to make your economy halt if you don't agree to trade in dollars and open your markets to the United States and pay these unpayably high dollarized debts by essentially privatizing your industry and selling it off. And you can pay the debts by selling what's left of your public infrastructure, your land, your raw materials, resources, your oil and gas and minerals. You'll get that money, and you'll use that money to pay American bondholders and the International Monetary Fund and the World Bank that has been giving you all the bad advice to become dependent on U.S. grain exports and general economic trade. So this is somehow, the de-dollarization isn't simply a technical issue of what kind of currency or arrangement are you going to make. It involves the whole economic system, which is why the Ukraine war has become so much more than a military confrontation, and has forced countries to think in terms of totally restructuring their economy in a way that's independent from Western Europe and the United States, from the golden billion, as President Putin likes to call them.
Yeah, I mean, actually, before I'd like to say something about de-dollarization as well. But before I do that, I just want to say one thing about a subject we were discussing earlier, because it's really pertinent. Everybody will remember that some months ago, Western powers were making a big deal about permitting grain shipments from Ukraine. And everything was couched in terms of, Ukraine is the breadbasket of Europe. All these poor third world countries depend on Ukrainian grain shipments and so on. But you know what the reality behind it? What was the real reason? Because I mean, it's not like Western countries have hearts are bleeding for third world countries. I mean, they've been squeezing third world countries for 2 centuries now. But the point is, the main reason why they are so eager to get grain shipments out of Ukraine is a fact that few people know. A large part of the farming, even before Ukrainian land could be sold, it was allowed to be leased. So as a consequence, Western big agribusiness corporations are heavily invested in Ukraine. And even many corporations that are apparently Ukrainian are headquartered and have interests, involve Western interests and so on. So this was the grain of this agribusiness that had to get out. And I think, again, we always have to look for the real motivations. I think people should really understand, all these pronouncements about aiding Ukraine and so on they're all hollow in some respect or another. But anyway, coming to de-dollarization, let me also plug the fact that next week around Michael and I, around this time, Michael and I are going to record our program on de-dollarization. So if you're interested, please listen to that. But you see, I would like to start really at a very fundamental level, because what we will not understand what is happening under the rubric of de-dollarization, or not fully understand it, unless we consider a very simple point. It is not possible to have the currency of one country be the currency of the world. People say, oh, what about the dollar and what about sterling? Well, the point is, each of these has not only had special circumstances. In the case of sterling, essentially, Britain was providing the world with liquidity by exporting the surpluses it extracted from its empire, both directly as taxation and indirectly in the sense that all the trade surpluses that its empire was incurring with the rest of the world by, essentially producing their guts out to send, food and tea and all sorts of raw materials and cotton, etc., to the rest of the world market. India was the second biggest exporter in the world at the time. And so it was earning a lot of foreign exchange for and capital for Britain. And so all of this was being sent. So Britain could do it because it had an empire. Otherwise, what was tiny little Britain ever going to do, even at the height of its industrial power? And the dollar never really succeeded in the post-war period. I mean, it spent basically a crisis-ridden period in the 50s and 60s, and then the gold link had to be broken. And since then, the dollar has only remained the world's currency by creating artificial demand for the dollar, by expanding financialization, and of course, a third thing, which is essentially preventing third world development. Because what third world development would do, if third world countries really develop, is increase the competition to purchase commodities. Increased competition to purchase commodities would mean higher prices of commodities. Higher prices of commodities, as those who have watched these things know, is inversely related to the value of the dollar. So in this sense, this is the most fundamental point I want to make. And then, of course, I would say I completely agree with everything that Michael said. And I would say, add to that basically, what is it about the Ukraine war that has done this? So if you take what I said seriously, then you will also understand that the dollar's position has been weakening for some time now. And also, and so what the Ukraine war has done is it has accelerated that position. And that weakening comes from a multitude of sources, including the fact that the financialization scheme, the idea that we can simply expand international demand for the dollar by expanding financialization and inviting everybody into the giant casino that is the dollar-denominated financial system, even this is not working. Because after 2008, foreign money has basically not been coming in, which is partly why the Federal Reserve has had to support all these asset markets. So in that sense, it has been weakening. And yes, then what has also happened is that the rest of the world has seen that the rest of the world had many complaints about the dollar system anyway, because it works completely in ways that are governed by the US requirements. So when the US interest rates are low, money floods out of the US into the so-called emerging markets, driving up the value of emerging market currencies. And then when the dollar, when they increase interest rates, and the money rushes back to the United States. So this kind of dollar system is of no good. It does not provide stable finance. So the big thing that's driving the decline of the de-dollarization is that now there are alternatives. China is an alternative source of finance, which is far superior to anything the USS can offer. And as Michael says, the countries are also realizing that they cannot rely on this crazy casino system, and they need more stable arrangements amongst themselves, and they are creating them. And one final point, which is that the weaponization of the dollar system, not only in the case of Russia, but remember there was also the they sequestered Afghan reserves, and they are subjecting Afghanistan to the most inhuman forms of starvation, lack of medical equipment, etc., etc. They've done similar things to Venezuela, Argentina, and so
on. Yeah, I mean, those are all great points. It just goes to show how connected what's going on in Ukraine is to the rest of the world, and how much, China calls them headwinds. There's been a huge fallout from the Ukraine proxy war, and de-dollarization is for sure one of them. Michael, how will this process, do you think, play out? Like, there's a lot of different I think theories about how fast this will go, whether the dollar will be replaced in the next 5-10 years, or maybe it'll take several decades. How do you see this development moving forward, given that it feels like we're going to be in the midst of this proxy war for some time, despite whatever references to a peace deal and to peace that the U.S. and NATO have been making of late? It feels like this is going to go on for quite a while. So how do you see this going? I mean, I know we can't predict the future, but I guess there are some trends that maybe can point the way forward.
Yeah, can I? I wonder about that. I think that there are...
Well, Radhika, let's let Michael, because let him first, and then you can follow up for sure.
Okay.
No, I'm about to say something, and the dollar is not going to be replaced to disappear. The dollar will remain the center of the American and the European trade. The problem is, what can take its place? Well, what can take its place has to be a systemic answer. Any foreign currency is given basically value by being accepted as payment for debt or payment to the government. If the government accepts the currency, that creates a demand for the money that it creates. Now, if the key is you establish a currency's value by taxes, taxes are something that are political. In order to have a common currency, you need to have an intergovernmental arrangement for political agreement on what will the taxes be paid for? Who will receive the taxes? It almost imposes a political union among the countries that are using a foreign currency, unless what they arrange is simply a group of bilateral swap agreements, like Saudi Arabia is making with Russia, and various countries are making with China, or a kind of artificial something like Keynes's proposal for special drawing rights that a new alternative to the IMF will create. I know Radhika will have something to say about this. An alternative that will create artificial currency. The question is, how do you give this artificial currency a value outside of the countries that are using it? You're going to have two different you can almost say two different civilizations, which is how Lavrov and Putin have been saying it. You're going to have one part of the world developing independently of the United States with a mixed economy, basically moving towards socialism, and the neoliberalized, financialized United States. These will be rival political systems, and really a whole different way of organizing the economy, politics, and values. And that's going to be much harder to put in place than simply doing a technical financial arrangement. It was easy for countries to break away from the SWIFT bank clearing system, and the United States threats had given Russia and China time to put in place their own bank currency system, their own credit card system, all of the financial details. But to have the balance of debt between countries. When countries have an imbalance in trade and investment, if China is going to develop infrastructure all along the Belt and Road Initiative, for instance, other countries are not going to be able to pay immediately. Ultimately, these equity investments that China's making will generate enough revenue to pay them off. But how are you going to handle this in currency, these mutual debts in the interim? That's what has to be developed, and it's a political question that most countries have not asked, especially if they've sent their students to the United States or England to learn economics, when the economic curriculum doesn't even discuss the kind of things that we've been discussing here for the last hour. For your audience, they don't discuss the political context for what a market is. They don't discuss how a government, a group of governments can create their own market relations and means of payment and means of debt settlement. So all of this is going to be linked to how do you handle the imbalances in trade and investment that develop among countries that decide we've got to go it by ourselves. We've got to be independent from the United States. And if the United States says you don't use the dollar, then you can't import anything from us in Europe. They've got to be prepared to really start all over. And the good thing is, if they start all over, it doesn't have to be the way that the United States and Europe developed. It doesn't have to be Margaret Thatcher's way that Europe and Ukraine and the United States has followed. It doesn't have to be the neoliberal way. It can be the way in which socialists have talked about for the last 150 years.
Yeah, and if I may add to that, I mean, Danny, your original question was, do you think the dollar system will go away now, soon, later? I think that Michael, part of Michael's answer was that it's quite possible that it will remain the currency of this Western bloc. But remember, the Western bloc already has in it the euro. And also, of course, other stronger currencies. So I think that that's something we have to bear in mind. One of the things that, and also financial relations between Europe and the United States are not as strong as you might think, because basically what happened in the first decade of the 21st century is that as the US financial system was inflating those crazy asset bubbles based on the mortgage-backed securities and so on, the big buyers of these asset-backed securities, these toxic securities. Of course, there American corporations and financial corporations were among the big buyers. But outside the United States, UK and Eurozone financial institutions bought into this market in a big way. And in fact, that is why also they were the ones that were hurt the most. So, when people refer to what happened in 2008 as the global financial crisis, I always say there was nothing global about it. It was a North Atlantic financial crisis. And so that's, and interestingly, as the English expression goes, once bitten, twice shy. What we have seen thereafter, as various reports have pointed out, is that European countries have not been investing in American financial markets quite as much. They have sort of retracted. The flow of money from Europe to the United States is massively down. So that means that the United States, for the US to function as a dollar system, it has to actually have inflows from elsewhere, which are not coming, which, as I said, requires the Federal Reserve to support asset markets. Now, that is proving difficult in the present inflationary context. So the US is caught in a vice. And as a result of that, I think there may be some dysfunction there, which may lead to a collapse of the dollar. We don't know. But so that's the one thing. And I also agree with Michael that, of course, the other thing that is accelerating the move away from the dollar, and that acceleration can suddenly become, very significant, and that is the availability of alternatives. Now, earlier I had said that a national currency cannot be the world currency. Keynes knew that, and he arrived at the Bretton Woods conference with proposals for Bancor, not SDR, Bancor, which is just the name he gave to this currency. And the key thing about this currency was that it was not a currency you and I can use to buy a chocolate bar. Okay, it was a currency only to be used between central banks. And I think this kind of arrangement can be made on a bilateral, multilateral, many different types of basis. And I think that this is how, for example, the Argentine arrangement that has been made, the Argentine and Brazilian arrangement that has recently been made, has been criticized by people who don't know these sorts of things. They're saying, oh, it's just a central bank currency, it can't be worth much. But no, money is national. Keynes understood this. And what we need is a way of settling imbalances between central banks. That's what world money needs to do primarily. We don't need world money to pay for restaurant meals or buy a chocolate bar or shop for shoes or whatever. That money can remain national. And I think that that's what Keynes understood, and that has been forgotten with all the hype about how natural it is for the US to be the world's money. It's not natural at all. It's based on a whole bunch of shenanigans, which, some of which we don't even know about. So in that sense, I think that as these arrangements multiply, which I think they will for reasons we've already talked about, there's also going to be a move away from the dollar. And at that point, we'll not really even care what the dollar's worth. I mean, how much do we care what is the worth of I don't know, the Korean won? We don't worry about it. Koreans worry about it, and that's what will happen.
Well, what are we going to do about the backlog of dollarized debt that countries have? Their foreign debt has been denominated in dollars. They can't; these debts cannot be repaid and have these countries develop independence from the United States. Something has to give. And not paying the foreign debt because you're using your money to develop your own economic independence, your agricultural independence, your industrial independence. If that is given priority, then the United States is going to sort of force a split. That's the problem that has to be solved.
Yes, and I think that you're right. And the United States will try to resolve this by force. But I think what may also happen, of course, is that if countries stop incurring new debt in dollars, then this will look very different.
Yes.
That's so true. Yeah. Yes. I wanted to. We've really gone we've gone through the specifics, and now we're getting to the general, the particular to the general. Now, I'd like your reactions to, the IMF and major financial institutions and big banks are all kind of predicting a very slow 2023 economically. I mean, when it comes to the US's numbers in particular, if we just take the mainstream definition of a recession, we would say that the condition of the United States, given that it'll have less than 1% growth predicted in 2023, is recession. And so how do you feel like this global economic or world economic slowdown is related? And Michael, I know that Radhika has some stuff she's got to take care of. So in terms of this global economic slowdown, how has the Ukraine proxy war impacted this? How is it related? And how do you see the US and the EU in particular reacting? Because China, for example, is going to grow 4 or 5 times the rate. Russia, although it might not experience that kind of growth, it's not falling apart. So it seems like big trouble in terms of the geopolitical agenda moving forward on this economic point alone. And Michael, I'd like your reaction.
Well, we're not in a world of business cycles anymore. We have entered a period, by we, I mean the United States and Western Europe, are in a permanent, chronic debt deflation, a chronic depression. I think we've discussed before, every business cycle recovery since 1945 has started from a higher and higher debt amount of debt. Usually the function of a business cycle crash is that you wipe out the debts. Bankruptcies transfer property from weak to strong hands. That didn't happen after 2008. We're in, you can call it the Obama depression. Obama had a choice. The bank fraud in the United States, as Bill Black of Kansas City has explained, was so great that Citibank was insolvent. All the big New York banks and firms were technically insolvent. Normally, they would have gone broke. They would have wiped out all of the 1% holdings. They would have wiped out the stockholders. They'd end up basically with a debt cancellation. But Obama said, no, we're going to save the banks, but we're going to kick 10 million American families out. The economic war is on, and the race war is on. All of these victimized Black, Hispanic, and low-income borrowers with junk mortgages are going to be evicted and wiped out. We're going to impose a depression on the American economy to bail out the Democratic Party's backers, the large Wall Street firms, and the 1%. And so since 2008, the 1% have had an enormous increase in wealth, in the value of stocks, bonds. You've had the largest bond rally in history since 2008, an enormous wealth at the top. And what form does this wealth take? It takes the form of the debt of the 90% of the population. So the United States now, the economy, 90% of the people cannot afford to increase their purchase of goods and services, which is what a recovery is, and at the same time pay their mortgage debt, their credit card debt, their auto debt, their student loans. All of these debts are increasing, making a recovery of the real economy impossible. And the same thing, of course, is happening in Germany now that you have the industrial sector basically wiped out by the American sanctions. So you're going to have the West basically in a shrinking economy. The only way that the 1% and 10% can continue to get rich is by exploiting the rest of the world economy. And the rest of the world, if it lets this happen, is going to itself be forced into a chronic depression. And that really is the political issue. In terms of the coming year, I can guarantee you that there's not going to be a recovery, because how can you have a recovery in goods and services if your money is going to pay debts, to pay a higher monopoly rent for oil and gas, higher monopoly rent for food prices, for health care? How can the economy do all of these things at once? It can't. And I think most of Wall Street knows it, and certainly the United States, the State Department and Treasury people know it. All they can try to do is say, well, let's get everything we can to the last minute, and then take what we have and basically take the money and run. Where do we run? Maybe we can buy Ukrainian land or New Zealand land or Australian land. What can we do? That's the question they have. And there's all of these American dollars that are going to want to convert into Chinese currency, Indian currency, Turkish currency, all to buy foreign assets in countries that are not subject to the same debt deflation that is plaguing the West. And the question is, how are other countries going to avoid their own debt deflation that is completely not domestic so much as owed to their foreign creditors for bad debts? And the only answer that I can see is these bad debts are really bad loans. They're bad loans because they can't be paid. And a loan that can't be paid should be wiped out. That's what has been happening for the last 3,000 years of civilization. The dollar debts will have to go, and if that goes, there goes the underpinning of the American banking system, the financial system, and there's really nothing that the United States can do about it. It doesn't have a military solution. It doesn't have an acceptable economic solution. There's really nothing that their economies can do except that the upper 10% know that the economy can't recover. The trick is to convince the 99% or the 90% that somehow everything is going to be all right. The economy can indeed recover, even though we're going to cut back Social Security and Medicare. That's a key. I think what to answer your question, you're now seeing the Republicans joined by the right wing of the political spectrum, which is the Democratic Party, wanting to cut back Social Security and Medicare in order to balance the budget. Imagine what's going to happen in the United States if the United States says, now we have to have an enormous military expenditure because of the war against Russia. We have to defend Europe and rearm Europe. We're going to have to vastly increase the American military budget so that Russia can't do to us what it did to Ukraine. That's how President Biden will speak. If there's this increase in military spending of the United States budget, then something has to give. And the Democrats have agreed with the Republicans that what has to give is Social Security. Just like Macron is raising the retirement age in France. You've seen the riots over there. You're going to have all sorts of gimmicks in cutting back Social Security, the post office that'll be privatized, medical care. What they are not going to do is make Social Security payments be paid by the 1%. There'll be a cutoff. Only the wage earners and the middle class have to make Social Security contributions at present. The rentier class, the wealthy people, do not have to pay Social Security in proportion to their own income, unlike the rest. So you're going to have the class war in the United States back in business, and as usual, it'll probably take a racial form. It'll be an ethnic war. It'll be a geographic war between various parts of the United States. So all of this is going to be the backlog of having basically followed the dissolution of the Soviet Union with a Cold War economy instead of an economy of economic growth. And finally, the Americans and Europeans are going to say, do we want to grow or do we want a military economy? The vote will be overwhelming. We'd rather have a military economy and sacrifice and not grow, as long as all of the pain is felt by the 99%, by the wage earners, not us.
Mm. Yeah, I just want to say, Michael said the class war is back. The class war never went away. Neoliberalism has been nothing but a class war by the 1%, by the rich, against the working people of the United States. And I would say that we are probably going to, at least now, beginning finally to see, I mean, the class war has never been completely unresisted. That is, the capitalists' class war has been resisted by working people. But I think now we are going to see a turnaround. For example, this morning, I see that in the United Kingdom, where there have, of course, there have been a series of strikes. Yesterday, they had a sort of mini general strike, for example. It has just been reported that Shell made some astronomical amount of profit. Meanwhile, ordinary British people do not have the money to buy enough heat, enough electricity to heat themselves. And electricity companies are sending people to barge into poor people's homes and install these meters into which you have to pay in advance. You put coins into it. It's a coin operated, it's horrific, but it's a coin operated electricity meter. And poor people have to use that. If they don't have the coins to put in that machine, they don't get heat. So this, I mean, ordinary people can see the obscenity of this, and of a government that refuses to increase corporate taxes on these huge monopolistic rentier profits, which needs to happen, you know. And nurses and railway workers and everybody who is striking, is teachers, are basically saying, you're telling us there is no money? Look at these profits. That's where the money is. If you want the money, you know where to get it. So I think that there's no doubt that there will be an intensification of the class struggle right now, which and it will be now more two-sided than it's been through bulk of neoliberalism. But I would say that, in term, your original question was, how seriously do we take the IMF's very, very dire projections about world growth? Now, I just like to say one thing, that in this world growth, basically, whatever projections the IMF is making, the bulk of the contribution to growth will be from China. Why? For the simple reason, if I were to summarize all the different things that Michael is saying, it is because the overwhelming majority of countries, and that includes, I'm sorry to say, many countries that are part of the rest, so to speak, for example, India, are pursuing horrifically neoliberal policies. And neoliberal policies are not about growth. They are about transferring income from ordinary people to a tiny, ever narrower elite. And this is what's happening in India on a massive scale and on a tragic scale. And there are some other countries as well. So I think as more and more countries, of course, by contrast, the election of Lula in Brazil has been a breath of fresh air. And I think as more and more peoples realize that they have to elect governments that are going to run economic policy in the interest of the majority, in the interest of as the majority as opposed to a tiny minority, in the interest of production and environmentally sustainable production as against environmentally ravaging predation and rentier income. Because, one thing people don't realize, people oppose production versus environment. Actually, that's not it. If you look at the graph of practically any environmental damage that you may see, it shoots up in the neoliberal period. It was not, so the neoliberal period has been a period of low growth. But the environmental devastation has actually gone up. What this tells you is that you can have a better pattern of growth. By growth, we don't mean that we should consume more and more resources. We just mean there must be ways to increase people's welfare, their access to the basics, food, education, housing, etc., etc. And I think more and more as people around the world realize that there is nothing to be gained from the neoliberal model, and they start demanding other economic policies, I think that things will change. And of course, in the Russian case, to come back to our political economy of the Ukraine conflict, what's really interesting to me, if you focus on Russia for a second, President Putin has never been particularly, he's a complex figure. He's said things like, no one who does not lament the demise of the Soviet Union. Those who do not lament the demise of the Soviet Union have no heart, but those who want to bring it back have no head. So you can see he has a complex view, but he has always been basically running the economy for oligarchs on a broadly neoliberal model. But what the sanctions and subsequently now the war, sanctions from 2014, now the war, have forced him to do is to actually pay attention to the productive aspects of the economy and make the Russian economy more resilient. And of course, now that it is coming so close to China, in many ways, I am sure that the demonstration effect of running essentially what is a socialist economy, yes, there are capitalists in China, but they are under the overall direction of the Communist Party and the economic policies it makes. So as this model, which has proven so successful, is also seen as something to, if not emulate, at least to learn from, I think that this is where things will change. The next year is nothing. The next year is not going to be particularly pretty in terms of growth. But I think in the long run, this is the source of hope, if I may put it that way.
Last week, 2 days ago, Foreign Secretary Lavrov made an interesting point about this. He said that this alternative to the neoliberal model, it has to be based on historical analysis. And he pointed to an article that the U.S. Secretary of State Blinken wrote in 2019 in The Atlantic. And Blinken said, no vision of American exceptionalism can succeed if the United States does not defeat the emerging vision that emerges from ethnic and cultural identity. Well, Lavrov called this remark terrible because he said this denies other people the right to remember their history. And their cultural identity is the culture of not letting the financial sector dominate the entire country. The identity of having a society that is more egalitarian and does not permit a whole class of landlords and monopolists and bankers to have a free lunch of exploiting income without producing anything. That's the basically the United States, to prevent any alternative to this neoliberalism, to say the market means that the rich people get to control what's bought, to control politics, to control the tax laws, and to control the country, just like the United States does. America, that's what America does, and we have to spread that all over the world. And any country that does not accept what we're doing can look at Ukraine to see what might happen to them.
Yeah, and
I just want to, because we are heading toward the end, I want to ask one final question for both of you before we end the interview portion, and then I'll get to some announcements. But before I do that, be sure to keep liking the stream, everyone. We have 770 viewers, a little under 650 likes. Let's get it up so more people see this, because this is I think, really important from what you were just saying, Michael, and also Radhika too. We've had Jens Stoltenberg. He's traveling all around Asia. He's been making this connection between Russia and China and their strategic partnership as being a huge threat to the values of NATO and the values of this rules-based international order. And of course, throughout this special military operation waged by Russia, we've heard a lot also about China and Russia and their closeness, their relationship, and what it means in connection not only to the political and military situation around the world, but specifically economically as well. So what exactly is the threat here? What do they mean by values and interests? What are Russia and China doing together, maybe apart as well, that sparks this huge concern? And of course, this predates the Ukraine proxy war, but it feels like it has accelerated this fear, this sounding the alarm, and even at times, I think, scapegoating as well. And Radhika, I'll let you get the first word, and then Michael, if you want to close.
So your question is, what is the concern vis-a-vis China?
Yeah, China and Russia, their strategic partnership. What's the threat here?
Well, I mean, the thing is that, if you go back basically to, throughout the whole last decade, I mean, more and more what you find in official documents of the United States, there is this creeping intensification of identifying China as a threat. And the reason is very simple. China is a threat because, in the 90s in particular, in the 80s and 90s, as the United States and China seemed to be sort of working together cooperatively, after Nixon's visit and the normalization of relations at the end of the 1970s, the expectation of the US ruling establishment was that China will simply become a sort of a subordinate, kind of almost like a colony, subordinated neoliberal economy. And it soon became clear, actually, it was already becoming clear from the middle of the first decade of the 21st century, but certainly after 2008 and the increasing talk of multipolarity and so on, it became very clear that, in fact, China was sticking to its own guns. It was going its way. Yes, it was happy to cooperate with the United States, happy to get investment, happy to get export markets and all these things. But as far as it was concerned, it was continuing its a socialist path. And also the socialist path was paying big dividends in terms of, increasing, basically the Communist Party of China has executed over the past many decades the greatest industrial revolution in the world. I mean, no country has become so industrialized, not only in terms of quantity, but in terms of quality of products and so on in such a short period. So basically, China has emerged as a rival to the United States, and that is what the United States cannot suffer. So, of course, the US people in the United States who particularly want to keep the military-industrial complex going and don't have too many gray cells to figure out that they are actually endangering the world and so on, they are going to talk up this coming war to China. Recently, 2 or 3 days ago, a general in the US Army was talking in really lurid terms about how Americans should prepare for war with China in the next 2 or 3 years and so on. I mean, this sort of talk, and they think that they are going to provoke, just as they are creating a proxy war against Russia over Ukraine, they're going to create a proxy war against China over Taiwan. But I think they will find that the scenario is very, very different there. Number one, China is a much more formidable enemy. Number two, I don't think Taiwan will be that easily manipulated. Number three, I don't think the Europeans, who have been, as I have underlined, reluctant to go along even on the Ukraine matter, although they have gone along sort of, I think they will be even more reluctant to go along on the Taiwan issue. So I think that this does not preclude the possibility that the United States will initiate some sort of war, try to provoke China in various ways and so on. But honestly, and that can have horrific consequences, but I would say that the picture is very complex. So, yeah.
Okay. Well, I think the threat is not simply GDP growth, but it's systemic economic organization. The threat of China is not letting U.S. investors buy control of their economy. It's not letting U.S. banks create their bank credit at interest, but keeping money and banking as a public utility by the state, not private creditors, and for creating money to essentially create new means of production, not simply for creditors to buy existing housing, existing plant and equipment, existing production, and then loading it down with debt to extract all of its surplus value. So, and the threat is that China will tax away the free lunch. It'll tax away economic rent. It will prevent super billionaires from developing, unlike the United States. It won't favor absentee landlords and favor monopolists and financial investors and let them take over the economy. All of these things are what the United States says is a free market and is a work of nature itself. So the real threat is doing things in a different way than the United States self-destructive, finance-oriented way has been developing.
Yeah, well, we have covered a lot in this conversation, and I really appreciate you two taking the time out this afternoon. As a reminder, you can find the links to Michael's website. It's a link to his latest book. And you can find also a link to Radhika's latest book as well, which is free on open access. Do you two want to just let people know where they can find you and anything else you'd like to mention?
Well, Michael-Hudson.com is my website, and I'm on a number of others. And I've outlined most of these ideas in the recent book, The Destiny of Civilization. And I'm about to have another book out next month, The Collapse of Antiquity, which is really how Western civilization itself took a wrong track 2,500 years ago. And Radhika and I are frequently together, as you mentioned at the beginning, on our geopolitical discussions on the Ben Norton site.
Yeah, so exactly. The discussion that Michael mentioned is called Geopolitical Economy Hour. It appears on the website of Geopolitical Economy Report, which is the recast version of Ben Norton's website. And as far as I'm concerned, please do check out my book. It's called Capitalism, Coronavirus, and War, a Geopolitical Economy. It was just published in December, and it's available as Danny said, open access. If you're interested further, please also check out Geopolitical Economy After U.S. Hegemony, Globalization, and Empire, which was published by Pluto in 2013, and I think its analysis has really stood the test of time. And finally, just Google my name, and you will see a lot of YouTube videos, a lot of articles, many of which are available open access. Thanks.
Well, thanks so much to both of you. Stick around,
Now, you debunk the big myth about fiat money, the erroneous notion that printing money will lead to harmful inflation. Do explain, and also, if you take this tool away from central banks, you're trying to limit what they can do, right?
No, I actually want to give the power to central banks. Let me explain. Essentially, I think we've got so much debt in the world that we're not simply going to grow our way out of it. And that is an analysis completely consistent with what economists such as Ken Rogoff have written, and both in his book and in various articles with Carmen Reinhardt, etc. I think we have so much debt in the world that one of about three things is going to have to occur. Either we're going to have to maintain interest rates below the rate of inflation for a long, long period of time to erode that real value of debt. But with the irony that while that'll help erode the existing debt, it creates incentives to make a whole load of new debt creation in the future. Or we're going to have large explicit debt write-offs, people actually default on debt. We'll have some of that. I mean, Greece is not going to repay all the debt on its balance sheet, let's be clear about that. Or we have to have what people call monetization, where the central bank buys government debt, and not just temporarily, but tears it up, does it permanently. Now, I think we've got to debate the relative role of these different things. I'm worried about the first one, as between restructuring and monetization. I would respect people who say it should be primarily restructuring and default, but there are disadvantages with that as well. But the starting point of sanity in this debate is to look at the amount of debt in the world and understand that it's going to be one of these three. We're not just going to, magically grow out of it. In that environment, I don't think we should exclude what I call overt money finance, and what Milton Friedman, a man whom I would point out was not a mad left-wing socialist nor an inflation lover, what Milton Friedman called helicopter money, which is the central bank actually printing fiat money to expand the economy and to make sure you hit inflation targets. Now, in technical terms, it is absolutely clear that a central bank could do an exercise in retiring current government debt by buying it and ripping it up, or could print money in a Milton Friedman helicopter money exercise, and there are no technical reasons whatsoever why that will lead to hyperinflation. If you did a very small amount of it, $10 million, you wouldn't even notice it. If you did 10 billion, you'd have a somewhat stimulative effect. If you did 10 trillion, you'd produce high inflation. If you did 100 trillion, you'd undoubtedly produce roaring hyperinflation. This is a tool where the impact will depend on how much you do. And if anybody says that's not true, I think they simply have not done the work of analysing it technically. But what is absolutely right is that there's not a technical risk here, there's a political economy risk, which is once we break the taboo and admit that it's possible, what's to stop the politicians saying, well, you told me 10 billion would be useful, but I'd like to do 50 billion. I'd like to do 100 billion because it's coming up to an election and I'd like to stimulate the economy and give my constituents some benefits. And that's why I actually have argued, not that we should take this tool away from central banks, but that we should precisely give it to central banks. That central banks pursuing inflation targets, such as 2% plus or minus 1%, should have the power to say to government, we're suffering a deflationary problem, and in this environment, the best way to get back up to 2% is to have X billion of money finance deficits, Milton Friedman helicopter money drop, but with the central bank given the complete power to say the maximum of that can be done. I don't want this power to be at the discretion of politicians because, like other people, I think they may well misuse it. But I do think that it should be an available tool for central banks to agree the maximum amount of this that there should be.
So they're your choices of imperfections.
There are fundamentally two ways to produce a growth of nominal demand within an economy. And we often don't think about this, but I think it's important to go back to the absolute basis of them. Either you have an expansion of what's called sovereign fiat money, the stuff that only governments can create, which is either the notes and coins in our pockets, or it is the reserves, which are the liabilities of the central banks. And those are fundamentally created by governments running fiscal deficits and funding it with money, not with interest-bearing debt. That's one way that you get a stimulus to nominal demand. The other way you get a stimulus to nominal demand is that private credit grows, and that stimulates nominal demand because, crucially, banks don't just take existing money and lend it on, they create credit money and purchasing power. These are two ways to expand nominal demand. Now, basically, what our dominant philosophy has been for the last 30 or 50 years is that we should have an absolute taboo against sovereign money creation the monetary finance of fiscal deficits. But we were totally relaxed about whatever the private sector did in terms of how much private credit and money and purchasing power it created. And what I end my book saying is we have got to recognise that both of these things are dangerous. One or other is required. We should not treat private credit creation as something which we can completely rely on the private sector to get right. We need some of it, but we need to control it. Nor should we completely exclude in all circumstances some monetary finance to create increased sovereign money. We are caught between the dangers of out of control private credit creation and the potential devil of the misuse of sovereign money creation, and we have to recognise the risks on both sides and to use both tools, but to control the risks on both sides.
I'm joined today by Reserve Bank Governor Adrian Law. Thanks for joining us, Adrian.
A privilege, Thomas.
I just want to start off, if you could perhaps explain to us what the role of a central bank in the time of COVID is.
Yeah, so it's no different than normal times, but it seems to be slightly higher profile. In the simplest terms, we provide notes and coins to the public. And so we want to have to make sure that access to those, to currency is readily available, particularly during lockdown periods. People get very nervous about not being able to do a transaction. So the currency has been a part of it. But beyond that, we bank the banks. And through banking the banks, we are trying to make sure that they are in the best possible position to support their customers. We've also been able to make sure banks have access to plentiful and cheap liquidity themselves, because they have to borrow from somewhere in order to go on and do their business. And so we opened up a series of facilities where they can come to us with their assets, we give them cash, they go out and do their business with their customers.
The Reserve Bank is separate to the government. You look after monetary policy, the government looks after fiscal policy. But one of your biggest changes that you've announced at the bank since COVID-19 really hit the economy was your large-scale asset purchase program. Now, obviously, this has the effect of giving effect to your monetary policy. It's not designed to help the government out, essentially, but it has, not necessarily inadvertently, but it has had the effect of lowering borrowing costs for the government, of allowing the government to borrow more cheaply. Do you see that the lines getting blurred a wee bit between your traditional independence and what's happening now?
Yeah, I think that's a fantastic question, and you were spot on around how these two things are symbiotic. Just to start very simply, the Reserve Bank is operationally independent to achieve low and stable inflation and to maximise sustainable employment. And the country's well used to see us achieve that through shifting interest rates up and down. Coming into this crisis, globally interest rates were already near zero, and we were very near an effective lower bound for using that instrument, the interest rate instrument, to manage aggregate demand. Fortunately, before the crisis, we had talked a lot about alternative instruments, and one of those was about large-scale asset purchasing. And this is where we're saying to banks, hey, we are prepared to buy assets off you, the government bonds you're holding, and give you the cash. And so through doing that, we are creating liquidity in the banking system and also keeping interest rates down. There's a ready buyer for the debt, and we're turning it into liquidity. And so that is us operating independently for the same purpose. Fortuitously, one of our concerns prior to this COVID was that there weren't that many assets to actually buy if we wanted to use that instrument. Well, gee, guess what? The government is printing debt rapidly because they are the main brunt of the fiscal support, and that has created a lot more assets out there in the market, government bonds, that we can buy. And so we can achieve our independent goal through large-scale asset purchasing, and at the same time it is also providing support, liquidity and an interest rate environment for the government. So it's kind of two birds, one stone. but they are still operationally independent. We don't determine the amount of debt that's going to be printed or how it's going to be spent. We're just simply changing those long-term assets into short-term liquid assets.
There are some people out there, I guess, who are looking for you to go further. They're looking for essentially you and Grant Robertson to take each other by the hand and for you to create the money and for Grant Robertson to spend it and to obliterate that barrier. Is that something you would ever consider?
I think it's important to consider those things. That's not meaning that we would be rushing to do it. No, not at all. But you want to know what are the optionalities, and more importantly, what are the actual differences. And the difference, is there's more similarities than differences. But the differences can be really important around the risks that you can create and hence the structures you might need to manage and mitigate the risks. So when I think about it, the similarities, so what you're talking about is quantitative easing, which is what we're doing now, government determines spending and we determine monetary policy, inflation. You could shift to, at an extreme, something called money financing, where the government says, I want to spend 100, Adrian, credit our account with 100. And that's just us, creating money.
And if they ask you that?
Well, currently I wouldn't be able to do it. It would be outside of our legislation and they would have to be going through a very transparent policy and process to achieve that. Now, the answer is you could achieve that, but you would have to achieve it with eyes wide open around what.
So kia ora koutou katoa, no mai haere mai ki te putia matua, no mai haere mai ki te hui tēnei rā, ko Christian Hawkesby toko ingoa, tēnā koutou katoa. So good afternoon, thank you for joining us. I'm Christian Hawkesby, I'm the Deputy Governor here at the Reserve Bank, and joining me today on stage we have Chris McDonald, our Manager of Financial System Analysis, Kate LeCain, Director of Prudential Policy, and of course the Governor, Adrian Orr. Here at the Reserve Bank we are charged with protecting and promoting the stability of New Zealand's financial system. Today we're here to talk about the May Financial Stability Report, which focuses on our assessment of the resilience of the New Zealand financial system and our strategy and priorities in the face of that assessment. So to the report. New Zealand's financial system is well placed to handle the higher interest rate environment and international financial disruptions. Globally, inflation is persisting at levels well above policy targets. Although many central banks have slowed the pace of tightening, the full extent of the impact of previous tightening is still to be seen. Here in New Zealand, households are facing increasing debt servicing costs as their borrowing reprices at higher interest rates. To date, there have been limited signs of distress in banks' lending portfolios, and this reflects the ongoing strength of the labour market and that borrowers have been able to adjust their spending and use previous savings and repayment buffers. That said, cash flow pressure among households and some businesses are growing. House prices have continued to decline and are now closer to sustainable levels. We recently announced plans to ease our LVR speed limits from their historically tight settings, and this reflects our assessment that new lending activity now presents less risk to financial stability. The extreme weather events in the North Island earlier this year have caused significant disruption and physical damage to households, businesses and property. New Zealand's financial system has been resilient to these events. Institutions continue to work with and support affected customers. However, it has highlighted the ongoing need and urgency to better understand and manage weather and climate-related risks. Finally, the capital and liquidity positions of New Zealand banks are strong. Profitability and asset quality remain high, and our banks are not materially exposed to the same interest rate risks which have contributed to some recent bank failures in the United States. So in conclusion, New Zealand's financial institutions are well positioned to continue to take a long-term perspective and support their customers through these challenging economic times. I'm very happy to take questions about the report. I should remind you that we are here again in a couple of weeks to talk about the monetary policy statement, so I can take questions on interest rates then. And if you direct questions to me as leader moderator, I'll draw in my colleagues as appropriate.
Just one further question. I mean, you noted in the report that we're seeing the increased debt servicing burden fall very unevenly. I mean, are we shaping up to see an extremely sort of unfair downturn here, where a sort of very small proportion of recent home buyers, suffer a big deterioration in their circumstances, where other people are untouched?
So the key message from us today is that the financial system remains resilient. The household sector as a whole remains resilient. We are aware that there will be different pockets of lenders, borrowers that do have different experiences. We're very aware of the cohort of borrowers that came through in 2020, 2021, when house prices were high and interest rates and test interest rates were low. That's why we've been talking about that cohort, giving them time to plan, look ahead. We have the benefit of having a very strong financial system, which means those borrowers can engage early with their banks about the plans ahead, and we've been very encouraged by the NZBA with the communications that they've had in that regard. Talk to your lender early.
You recently loosened the LVR rules. Is the RBNZ trying to put a floor under the housing market? And you're saying they're falling nearer to sustainable levels. Is there a risk they fall below sustainable levels? And what would that look like?
So just to be absolutely clear, the Reserve Bank does not target house prices. And so what's really happening here is we're looking at the vulnerabilities that there are in the financial system and using our macro-prudential tools to build resilience in the financial system against those vulnerabilities. If you go back 18 months to November 2021, house prices were very elevated. We were very concerned about them being significantly above a sustainable level and the impact that could have from a sharp correction, and that's when we put our loan-to-value restrictions on at their tightest levels. What's happened since then, as you know, house prices have fallen since then. They've come back closer to a sustainable level, as well as interest rates rising and banks having higher test rates, and all of those things mean that that vulnerability has abated, which means it's time for us to start easing those restrictions. We haven't completely taken them off because there is a wide range of uncertainty around where sustainable house prices are. And as you mentioned, there is still the full possibility that house prices spend time below a sustainable level, particularly in an environment where interest rate levels are high.
You say closer to sustainable levels. Do you really mean in the range at which we believe sustainable lands?
Well, Chris, do you want to talk a little bit about how we think about that in some of our measures?
Yeah, okay. So with house prices having come off that peak that we saw in 2021, the price now sits within the range of the metrics that we look at. So we have a group of indicators. They each take different perspectives. They are medium-term indicators. So, for example, we look at kind of trend or neutral levels of interest rates. So they can be thought of as being kind of over time, where do you think house prices might head? So that kind of comes back to that point in the near term, given that interest rates are as high as they are right now, they're above kind of where we think that neutral level is. It suggests that there's still a real possibility that house prices continue to fall.
Hi, Ainsley Thompson from Bloomberg. What kind of information are you getting from the banks about people who may not be in arrears in their mortgages, but are having discussions with their banks about being in distress, maybe having to restructure their mortgage, things like that? Are you getting any kind of details on the numbers involved and what sort of distress people are in?
So I'll pass again to Chris in a moment, but we are highly engaged with the banks when we put this through our supervisory relationships, through our teams that put together this assessment. So liaison with the banking sector is very important. We've quoted the non-performing loans numbers in the report. They remain very low. They've ticked up slightly. They remain very low. We know that those conversations are going on and are correspondingly at a reasonably low level at this stage as well. Do you want to give any more flavour to that, Chris?
Yeah, I guess what we've seen is some of the nearer term indicators. So I'm thinking arrears when you're 30 days past due, they've ticked up. And as Christian mentioned, from a very low level. I guess one thing I'd say is it's been reassuring to see the degree of resilience that we've seen to date. And that demonstrates to us that households have, in general, been able to adapt, whether that's through adjusting their spending or whether it's through using the repayment buffers that they built up when interest rates are low. So there has been signs that households have been able to adapt to the environment that we're heading into.
Tom Pilestraker from Stuff Again. I guess just following on from that, could you go into more detail about the support you expect banks to provide customers? I guess it's one thing to let customers extend their loans or switch to interest-only payments, but it's quite a different thing to actually forgive debt. Would you expect the banks to be doing the latter on any scale?
I think, key message from us here today is that the financial system is resilient, the household sector as a whole is resilient. There's very limited signs of stress coming through at this stage. And both us and the banking sector more broadly is encouraging these early conversations to be had. There are lots of different options that borrowers have when they go into periods where times are tougher, extending the terms of lending, going on interest only periods of payback. So there's a whole lot of options there. Banks are providing a very strong signal that they're willing to have those conversations and have them early. And having a strong, well-capitalised, very profitable banking system puts our banks in the position to have those types of conversations and provide that support.
Okay, thanks. But that doesn't really answer the question. I mean, should they be forgiving debt on any scale?
I don't. That's not a question for us.
And also, it mentioned that there were particular pockets of vulnerabilities and mentioned the agriculture sector. Can you talk about whether it's right across the agricultural sector, whether we're seeing it in dairy, beef and sheep, if it's sort of an area specific, and how you might see that playing out?
Largely dairy, but Chris, do you want to expand a little bit on that, touching on both dairy sector and commercial property?
Yeah, so in the business sectors, we highlighted commercial property and agriculture, and one of the key reasons for that is that those are two sectors which have on average higher levels of debt. So they're obviously therefore exposed to rising interest rates a lot more than perhaps some of the other business sectors. The second thing is for the agri sector, you've got kind of a number of factors that are creating challenges for them. You've got increasing input costs has certainly been one of those. For dairy, we've seen the payout, or expected payout for next season is much lower. So there's a number of the environment generally is tightening for them, and that is quite likely to have some impacts. But in saying that, I think from when you think about the dairy sector, we have seen an improving trend over a number of years. We've seen them reduce the level of debt and strengthen their resilience so that when times like this happen, they're in a better position for it.
Bernard Hickey from the Kaka. I'm curious about the comment that house prices are back near sustainable levels, and I noticed figure 1.5 shows New Zealand's median household disposable income to median house price is around 9. Is 9 times income a sustainable house price level, given for most of our history for the last 20 years we were close?
So I guess the key point that we're making is that house prices have moved closer towards sustainable levels. If we go back to November 2021, we were confident that they were very, very long way away from sustainable levels, and that's really what motivated putting those settings on in their tightest fashion. The direction is heading towards sustainable levels. There's a wide range of uncertainty around what a sustainable level of house prices is, and that's why we look at a whole different range of measures in the document. We've just shown that one chart. Chris, do you want to talk a little bit again about maybe the different types of indicators that we look at to give a bit more context relative to the one
Yeah, sure.
the document there?
So we look at it from a few different perspectives. So one is for a household, and you compare what it costs them to rent versus their mortgage payments. So that's one way we look at it. The other one that we consider is the cost of mortgage payments relative to their income. So it's kind of a slightly different take on the similar thing. We also look at investors. There's a rental yield perspective. And across all of those metrics, one of the really important components that feeds into it is where do you think the long run or trend level of interest rates is. And over 20 or 30 years, we've seen a decline in that long run level, and that has been a major driver in terms of the rise in house prices relative to income over time. I would just say as well, the other point here is that there is a difference between sustainability and affordability. Our focus here very much is on what is sustainable.
Sounds like it's slightly above affordable.
Is that a question?
Okay. No. Why choose to relax the LVRs now? What were the things that prompted you to do it?
So we've talked a bit about the motivation being that these tools are there to be used when the vulnerabilities are largest, and that's what really motivated having those on in their tightest settings back in November 2021. The other thing that we have to be really conscious of is that the trade-off between financial stability and efficiency that we're facing here, and we're conscious that whenever we put restrictions on the amount of lending that occurs in the economy, that is going to have an effect on efficiency and accessibility, inclusion. So whenever we put a restriction on, there will be credit-worthy borrowers who will otherwise not have access to credit that they should. So we need to be really conscious of that trade-off whenever we use these tools. Given that vulnerability has been abating, it comes into more equal balance where we now can have some regard to that efficiency of the financial system.
Janae again from the Herald. With LVRs, do you expect banks to use up all of their new limits that they'll be given?
No, we don't. As I mentioned earlier, the loan-to-value restrictions, they tend to, when you put them on, when the credit growth is very strong, interest rates were lower, they acted as a constraint. They were cooling the housing market, cooling off that vulnerability. Now our assessment is actually that's cooled off on its own accord, in part because interest rates are higher, because the test rates and that's the main constraint that borrowers are facing at the moment. It's the test rates that the banks themselves impose on that borrowing. So we don't think that high loan-to-value lending is going to increase significantly because of the actions that we've taken because of these other factors, but we just don't think that the restriction is required in the way it was previously.
Okay, so if there's a 15% speed limit for owner-occupiers, you don't think banks will go up to, say, 10% or 11%? They always keep a little buffer. Yep. But you don't think they'll go up as much as they normally would whilst maintaining that buffer?
That's the feedback that we're getting from the banks.
On both owner-occupiers and investors?
That's true of owner-occupiers. Is there any investors? The speed limit is it's 5%, so it's very much a margin of error thing.
Okay, and just on bank profitability, do you expect profitability to ease a wee bit, particularly the net interest margin, as monetary policy transmits, the report notes the lag and some of the issues that causes.
Yeah.
There's been a lot of attention around bank profits.
Yeah.
Do you think that'll cool off?
So thank you for raising that topic and highlighting the special topic that we have in the document. Part of what that special topic covers is where are bank profits now, what's a good way to think about them, what metrics should be applied to give a sense of where they are relative to history. We also talk about a number of temporary factors that have been supporting bank profits recently, such as low funding costs because of strong deposit growth, the strength of the economy in terms of the quality of their lending, and yes, some of those factors may evolve through time, particularly net interest margins as the yield curve evolves. So the special topic sets out where banks' profits are, what are some of the drivers. Key message there from us is that having a profitable banking system is good in terms of financial stability. It builds that resilience. We're in a position much stronger than those US banks and the experience that they've been going through. But that profitability also needs to be used to support customers, to build operational resilience, and that's where we'd really like the focus to be.
Okay, and finally, a broader question. The report notes the difference between the big and the small banks in terms of profitability. Some small players might say, well, the regulation is too heavy-handed, there's too much red tape, and they just can't compete with the big banks that have big regulatory teams and so on to do submissions and etc. Do you think that the regulatory settings are kind of promoting competition in the banking sector? I know it's a broad question.
Yeah. Kate, do you want to, I think this is a really good lead-in to talk about the Deposit Taker Act and the work that we're doing around proportionality and a proportionality framework.
Yeah, so proportionate regulation is incredibly important, so adequately weighing up the benefits of any rules against the cost that comes with them to ensure efficiency, which enables an inclusive, diverse and competitive financial system. So for us, as we move through to the implementation for Deposit Takers Bill, where we're going to need to rewrite the rules for existing deposit takers plus new non-bank deposit takers as well, we're thinking carefully about how that looks. We're not envisaging a one-size-fits-all approach. However, for existing regulated entities, we did get here by design in terms of a purposeful uplift in the level of regulation that we had in New Zealand to get us closer to a more globally standard.
Nau mai, haere mai. Welcome to this hui, which is about financial stability and your report of the Reserve Bank. Welcome to you, Adrian Orr, Governor, Christian Hawkesby, Deputy General Manager for Financial Stability, and Chris McDonald, Manager Financial System Analysis. We've done this many times, hoping that you can keep your remarks relatively brief so that we allow plenty of time for questions. Thank you.
Kia ora koutou katoa, morena koutou, ina rangatira, ka ringa mai, mihi mai, whakatau mai, tēnā koutou katoa. Good morning and thank you, Madam Chair, for that introduction. I won't introduce my colleagues, just note that I have more colleagues also joining us and many online as well. I just wanted to start off by acknowledging the high level of engagement that Reserve Bank staff have had with the committee and our role as advisor to you on the Deposit Takers Bill. This is a hugely important piece of legislation for us and will shape our future as a modern prudential regulator. So I wanted to thank you for your involvement in that. But today we're here to talk about the Financial Stability Report that was published yesterday morning, and this focuses on our current assessment of the resilience of the financial system, as well as our strategy and priorities in the face of that assessment. So to the report, and I will be very brief. There have been no shortages of challenges since our last report back in November. We have had extreme weather events. We've had the impact of higher interest rates globally being felt, including through the failure of a number of mid-sized banks in the United States. I'm pleased to be able to report that we are confident that New Zealand's financial system remains resilient. Why is that? Turning first to the banks, capital and liquidity positions are strong. Profitability and asset quality remain high, and our banks are not exposed to the same interest rate risks that have contributed to those failures in the United States. For those reasons, we're confident that our banks are well positioned to continue to take a long-term perspective and support their customers through the period ahead. And we welcome the comments made by the New Zealand Bankers Association to that effect as well. Equally, our insurers have been resilient to the recent extreme weather events with sufficient capital, profitability and reinsurance to be able to absorb the estimated $3 to $4 billion of insurance costs. Importantly, those institutions continue to work and support with affected customers. These events do, however, highlight the ongoing need and urgency to understand and manage weather and climate-related risks. And this is a task that we contribute to alongside our fellow regulators at the Council of Financial Regulators, as well as national and local governments. So I'll finish it up there. Very happy to take questions about the report. Also just remind you that colleagues will be with you again in short time, in a couple of weeks, to talk about our monetary policy statement and the outlook for interest rates.
Thank you very much. First question, Nicola Willis.
Thank you. Thank you for your comments. And obviously accept the Reserve Bank's assessment that the banking system is sound, but I'm very worried about the financial situation of a large number of New Zealanders. And I'm struck by the comments on page 15 that around 25% the current stock of mortgage lending was originated during 2021, and that current interest rates exceed most of, looking the way I'm reading the graph, most of the test rates used by the banks during that period. Mm-hmm. So am I right to understand that around 25% of mortgage lending hasn't actually been tested at interest rates as high as they are now?
So we are confident about the resilience of the financial system. As I mentioned, we are confident about the resilience of the household sector as well as part of that assessment. We are conscious that there are pockets of borrowers who are more exposed than others. There are a distribution of different borrowers. There is that cohort that were tested at lower interest rates and at times when house prices were a lot higher. At the moment, we're seeing very little signs of stress coming through that sector. We are seeing some, but from a very low base. We think that is in part because of the strength of the underlying economy, the strength of the labour market, the job security that gives people the confidence to continue managing their finances and meeting their obligations. We're also encouraged by the resilience of the financial system in the sense that does give those borrowers that are feeling stress options to work with their banks and look to revisit whether they take interest payment holidays or switch to interest only, and all these options that they have to manage their way through.
Standard & Poor's have highlighted that they're watching the size of our current account deficit and will be watching the budget. What's the risk to your modelling for these scenarios if they give us a credit downgrade?
We haven't majored on the current account deficit in the report. It's something that we're very, very conscious of. We note that the current account deficit has widened, has increased recently, and that's partly a story around the resilience of consumption and demand in New Zealand. Consumers have continued to consume, particularly through imports, and that's widened that current account deficit out. We take some comfort that for a long period now we've had a downward trend in our net foreign liabilities, and that's really a key source of vulnerability typically. So that is looking in better shape. if markets are worried about the current account deficit, what we're likely to see is interest rates rising and the exchange rate falling as part of that rebalancing. Some of that rebalancing is occurring already through what we're doing with interest rates on the monetary policy front to cool demand.
I think my point is, if you've already got 25% of mortgage lending beyond the limits it's been stress tested at, and then you add another interest rate hike on that, if we're downgraded, how resilient will our system be to that, given you're already warning that there's a risk of more significant drops in house prices in the event that distressed sales pick up? Couldn't we enter a spiral situation?
So we're not seeing concerns about New Zealand government debt in markets. I think if we saw concerns there would be certain things that we see in financial markets that would reflect that. We would see struggling government debt auctions. We would see New Zealand government bond yields rising relative to similar countries. We're not seeing that at the moment. Our assessment is that the New Zealand government debt is still relatively low compared to other countries, and that puts us in a strong position, in addition to having that resilient financial system that we've talked about.
So even so, Centric's data and your own data confirms that there is a growing number, hundreds of thousands of New Zealanders who are in debt arrears, who aren't managing. I think particularly of those people in negative equity who did actually what the Reserve Bank was telling them to do in 2020, 2021. They went and borrowed at low interest rates and kept the economy stimulated. And now they're in negative equity, may need to make a distressed house sale, are in significant financial distress. So do you think it's fair to say that the decision to stimulate the economy as hard as the Reserve Bank did has led to financial distress for a group of New Zealanders?
I'm going to give Chris a heads up to talk about some of the data in terms of what we're seeing in terms of stress and non-performing loans and the like. I mean, we stand by the measures that we took through 2020, or was it extraordinary times, if you remember the period. Through that time, it was really about cash flow and confidence to cushion the blow from an unprecedented global pandemic. And that was about lowering interest rates, providing liquidity, and ensuring that the financial system wasn't an obstacle in the economic recovery that we needed to see.
Yeah, sure. Thank you. Thanks, Madam Chair. I've got two questions, but they're kind of related. The first is I think I hear you saying that you've got confidence that our rating won't drop to the level it was under the national government with Standard & Poor's, but obviously they're independent and they do their own thing. But you're confident in the settings we've got. Just want to clarify that's the case. Do you have conversations with them and the like? Secondly, I wonder if you could comment a little bit further on the resilience of borrowers. We're not seeing the default rates that some might suspect, or that is being speculated on. There seems to be a resilience there, and what do you think underpins that?
So I'll ask the Governor to take the first question.
Just to clarify on the credit rating, and as you've mentioned, Minister, they're independent. They make their own views. They're looking at the data that is incredibly transparent to us all, and hence the conversation we're having here today. And so that is reflected already in current pricing, if you put it that way, around the risks of a change or no change in a credit rating, and that would be reflected through an announcement. By the time I got there, is probably already reflected in wherever an exchange rate is, or where long-term borrowing costs would be. And so it's mostly around the longer term, how that actually then impacts on mortgage borrowing costs and so on and so forth. There are significant lags. There are significant buffers between the funding costs and the actual lending costs and so on. So it's not a one-for-one situation or a wait to hear situation. And we chat with the credit rating agencies whenever they come through, but it's their call. Thank you, Chris.
I'll ask Chris to take the second half on the
kind of underlying resilience.
On resilience, yeah. So perhaps just to touch on the previous point as well. So the measures of non-performing loans that we look at are around, I think, 0.3 of banks' mortgage lending, which is still at a very low level, actually. And I think that reflects particularly the fact that we've had a very strong labour market, very low unemployment. In addition to that, recognising that with the rising interest rates, that is creating challenges in terms of debt serviceability. Households are being able to find ways to adapt to that. And that is a combination of using savings or the repayment buffers that they've built up. So over recent years, having very low interest rates, people were able to essentially more of their mortgage payment was paying principal rather than the interest component. And that means they're kind of shorten the maturity of the loan, and that just allows them a bit of a buffer that they can then extend that if they need to. So yeah, households have been able to find ways to adapt, and that's what we've seen.
Further supplementary from Simon Court.
Thank you, Madam Chair. So just coming back to that issue that you raised about the US situation, banks tipping over. The Federal Reserve has raised their interest rates by another 25 basis points today. How high could the OCR go in New Zealand before that would threaten financial stability?
And so I think this is an opportunity just to explain how different the structure of the New Zealand banking system is relative to the US banking system. Around 5 years ago, a decision was made by the US authorities under a sort of proportionality heading that their mid to small size banks wouldn't have to adhere or comply to the same regulatory environment that others do internationally. And that meant that their mid to small size banks no longer face the same liquidity regulation, capital regulation, stress testing regulation, and all of those things that our banks here in New Zealand do. So that gives us a lot more confidence that our banks are managing those risks much better than those US banks that have got into trouble. The New Zealand banks, in actual fact, and we've got a box on this in the document, take very little interest rate risk. So they're very much hedged. If interest rates go up or go down, it has a reasonably similar effect on their assets and liabilities. And that's something that gives us confidence that the financial system will have resilience through those different parts of the economic cycle. We've done stress testing, which we didn't major on in this document, but late last year, around what are some stressed environments that would really test the financial system. And that stress test that we published had mortgage interest rates up over 8.5%, unemployment over 9%, house prices down nearly 50% from their peaks, and we still had a financial system that had sufficient capital to continue supporting the economy. We continue to do those stress tests, over an environment of different scenarios. I think our most recent ones are moving into different climate-related issues as well.
A question, Simon Watts.
Yeah, thanks very much. Look, I want to come back to the question that Nicola Willis asked you around the 25%, because I'm not certain that you answered the question. The question was quite clear, is that can you confirm that the 25% or so loans that were stress tested and that went out in 2021, that they are now basically outside of their stress test limits?
That's what the data shows, yes.
Right, okay. So how do you contrast that? Your paper talks about New Zealand households are facing higher debt servicing costs, but most borrowers are adapting. Mm-hmm. We've just confirmed that 25% of loans are outside of their stress test limits. Page figure 1.3 looks at impairments on a 30-day and 90-day.
Yep.
Those curves are going up like a rocket. Yep. What's really going on? Because, there's those two aspects just don't line up.
So I think a really important part here, and Chris, you might want to chip in as well, is just sort of understanding what those test rates are about. And so, the banks test their customers for can they continue to service their mortgage at different interest rates. Those tests in themselves will still have buffers over that. So that's not a test that's such that when interest rates get to that point, they can no longer service their mortgage. It's really just that gives them a sufficient buffer beyond which they can still service their mortgage. What will happen is that as they get closer to those test rates, there'll be some adjustment in the consumption. I think Chris has really already talked about this to some extent. And that's sort of when you think about what's happening on the monetary policy front. We are lifting interest rates because there is excess demand in the economy beyond supply. We need to see demand cooling, and this is one of the transmission channels through which that is working.
Yeah, look, I get that, but figure 2.2, if you look in 2020 and you look at the dots that indicate the stress testing rates, they're all below 8%. You contrast and you say that 3 out of 5 loans are either floating or reset in the next 12 months. So floating rates are well above 8%. They're at that level. So they are exceeding the levels at which the banks have stress tested. So what are these other factors that make us feel comfortable that everything's fine?
So Chris will expand.
I think there was just one point I wanted to add to this, and that's those test rates kind of provide kind of a limit or how much a bank is willing to lend to a customer. For the vast majority, the customer won't actually borrow that full extent. So actually quite a lot of that borrowing will be well below that level. And so for those customers, actually they're essentially their buffers, we use that term, they're able to deal with the rising interest rates even more.
But at the same time, the data shows us that more people are going into mortgage arrears, that more people are going into other debt arrears, because we know that the last thing to go is the mortgage, right? People will not pay their credit card, they will not pay their rates, but the mortgage is the last to go. I noted the comments in the introduction to the report that cash flow pressures are growing and the buffers are likely to be tested. Aren't we in the worst scenario possible here? We've still got a roaring cost of living with high inflation eating away at the buffers. We've also got a significant amount of borrowing in the economy that is now having to accept a much higher interest rate than banks ever tested for. Doesn't that mean there is a real squeeze on, yes, a small group of New Zealanders, and yes, it may not completely threaten the stability of the banking sector, but there is a real squeeze on a significant portion of people who borrowed big during the COVID time?
I'll ask the Governor to say a word, but one factor that I would also mention in terms of those key issues that are occurring at the moment is the strength of the labour market. I think that is really...
So what happens if that comes under pressure, which every economist says it's going to in the next few months? Are we in for a really dark winter?
Thank you, Chris. And what you're talking through is what we would expect to see in the way in which monetary policy tightens spending behaviour, spending eases, and then interest rates can decline. Likewise, borrowing eases. So what you've explained is really the natural feed-through of tighter monetary policy impacting on spending decisions and behaviours, and then that itself easing inflation pressure. So what we are seeing is what we are hoping to observe, which is less spending to better match the supply capacity, inflation pressures easing, and the economy working its way through the current environment. So I would characterise it as business as usual with monetary policy, except with the background of a very resilient financial system and remarkably low unemployment historically across the side. And I'll just on the stress testing areas, I think it's important to note the word stress is used, but it's an indicator on when households need to think about other adjustments to their spending behaviour. It's not a point around when you have to hand the keys back to the house. That is what banks do. Banks don't want the houses back. They just want to know that customers can manage and work through alternative decisions, some of which we believe through monetary policy will be less domestic spending, which is what we need to see. So it's the way the financial relative prices are working through the economy.
Primary question from Chloe.
Morena. Just trying to kind of reconcile and understand the logic behind a few different points here, so please bear with me. So we've got, obviously on page 7, one of the headers is around proposing an ease the loan-to-value ratio limits given diminishing housing market risks. But then on page 15, as other members have raised, highly leveraged borrowers are at the most at risk of significant debt servicing stress. And I understand that LVRs are different to DTIs, but we're also operating in an environment where many are also continuing to expect OCR increases. So could you just step me through the logic of what feels like potentially getting more borrowers in with with the easing of the LVRs, but then potentially higher servicing risk and therefore risk?
No, it's a great question, and it's a really good one to highlight. And I think a really key element of it is that our loan-to-value restrictions apply for new lending. And so we put those loan-to-value restrictions back on and tightened them to their tightest settings through 2021, in particular into November 2021, when house prices were very elevated. We were very worried that they were a long way away from sustainable levels, and banks were doing too much lending to people with low deposits and creating those risks to those lenders, to those borrowers at that point. Since then, we've seen house prices fall, come back to something that's more sustainable, and so that gap and for a potential further fall has minimised or lessened. And that means if you're a new borrower now, you face less risk from a sharp fall from where we are. Also, banks have tightened up on their own accord in terms of the test rates that they're applying, and that's what we think is the binding constraint at the moment. We don't need to be in there putting a restriction on to constrain activity. We think that the banks are doing it themselves in this case. Also, that these macro-prudential tools, they are tools that we need to put on when risks are elevated and then take off afterwards. That they are things that we need to move back and forward such that we can put them on again later.
So I was wondering then if you could also just unpack further on page 7 around being confident greater share of lending at higher LVRs will not materially undermine households' resilience, but would help reduce the efficiency and inclusion costs of the LVR policy. So when you say efficiency and inclusion,
we're talking about there is that these macro-prudential tools are a really important tool for us to achieve our financial stability goal, and that's ultimately by legislation, protecting and promoting financial stability is the heart of what we do.
And maximum sustainable employment.
So on that side of the shop. We're also conscious, though, that whenever we put a restriction in, that there is an efficiency cost and there is an inclusion cost. And so we need to be careful and use those sparingly, that when those financial stability risks are elevated, that's when we put the restrictions on. But when they abate, we take them off, because there is that trade-off that credit-worthy borrowers won't have access to finance some of them when the restrictions are on. And so by taking them off, we improve efficiency, we improve inclusion and access to finance.
At a very practical level, someone might have a great job, great future earnings capacity, but doesn't have the 15% deposit that we put on, and so they are excluded at the margin for a period of time, and so that's the type of where the rub is.
Helen, you had a question.
Yeah, I do. I'd like to take you to the part of, I think it's page 24, which is about bank profitability. And it sort of works in terms of that stressed group of people. And I appreciate your comments about the stress. But it looks like the banks here are making greater profits than they are anywhere else. And I'm concerned about that because it gets passed on to the consumer. Can you tell me, have we got the settings right in that area? And I guess what capacity have they got to look after this group of people, given that they're making better profits than anywhere else?
Yeah, so thank you for raising that special topic. It was something that we thought was important to focus on, because this is something that has received a lot of focus, and there have been a lot of questions around bank profitability, not just to us, but to other government agencies as well. The box or the special topic sort of sets out the different factors that we think are driving bank profitability. Some of those factors are temporary. So, the plentiful funding that there's been, the deposit growth, all of those things which have kept those funding costs down, the shape of the yield curve, the strength of the economy, which has meant that non-performing loans and other things and those sort of credit costs are down for banks. So some of those things we think are temporary and may change through time. Others are structural factors, and we tried to highlight those. What are some of the structural factors? The special topic sort of illustrates that it doesn't appear that a higher level of risk is why bank profitability is high. It's not compensation for that. Actually, a risk by variance of revenue is reasonably low internationally. Some of the profitability seems to be through a lower cost base, particularly for the larger banks who benefit from those economies of scale, being an Australasian organisation and being able to leverage off the lower costs that they have from their parent. From our perspective, where profitability fits in is that it does provide that resilience into the system. We've talked about that. Capital, profitability, liquidity are all absolutely fundamental, and what gives us confidence around the resilience of the financial system. Also, that ability to continue supporting customers, and that's what we think is going to be really key going forward as we move into this environment that we're in, that we may see more stresses and strains, but also being able to having that capacity to invest back into their business and back into the operational resilience. And that's where we think we've seen the sort of failings more recently, particularly around the cyclone, the availability of cash, the access to ATM machines, whether branches could open, whether customers could get supported through those periods. So we think, operational resilience is really the area to invest into going forward.
Okay, we've got SUPs. We'll go Phil, Chloe, then Nicola. So.
Yeah, thanks. This is a really interesting discussion, and I appreciate the material that you provided in the report. There's some very useful potential explanations put forward, and the last comments you made about the potential for investing in resilience and supporting customers as a result of the high profit margins. But I suppose the next step to take the discussion would be to say, to what extent are those things happening, and to be able to quantify them. Because while you've provided, I think, a really interesting discussion of possible causes, none of it really speaks to what I think is the core question, and that is this good for New Zealand?
The outcomes.
Is this level of profitability good for the economy? Is it good for our people? And what does it say about the competitiveness in the market? Do you have a view?
Governor?
Thank you. And it is a very interesting topic, hence we were there, and you're right, we provided the normative, not the positive around what does it mean. A significant challenge for a more competitive financial system, the real interesting concept here for New Zealanders, the domination by few, which are internationally owned, who have a significant lower cost economies of scale, lower cost to income ratios. And so that is good in that sense, it's a fact. But is it then being played back into a more better outcomes for consumers? And so that's, that will always be the challenge. Consumers need to shop around. We need to be much more active, I believe, in how we are doing our banking as individuals. The regulatory settings and behaviours isn't going to really change that dial at all. It's going to be more around that we have. We've pushed hard around levels of capital. We pushed very hard around levels of resilience, cyber risk, operational risk. all of these risks. We take them to international best standards, which is why we're proud to be talking about the system as we are. But the next big steps around financial intermediation really are around access to data, digital currencies, the whole next wave. That is the way in which competition can enter without needing those massive economies of scale. So those are policies beyond the Reserve Bank.
Thank you.
Yeah, I mean, we've spoken at length and many times in these hearings about the social licenses of the banks and about expectations given that profitability to kind of reinvest. But the reality is, as you've also outlined, that there is no requirement to do so. So I guess just kind of what tools are there available, and or is it worthy of greater inspection? And as kind of a secondary part of that, one of the other key examples of these challenges that we've inspected before is the banks increasing their rates in anticipation of OCR increases and then getting a second bite of the cherry when the OCR does increase. Is there anything that could be done in that specific example or in that broader sense?
So, a couple of things. One internationally, I mean, open banking, the potential for digital currency, these are the big game changers for financial intermediation. Because that enables customers to move much quicker without all of the fixed investment and hassle of shopping around for your financial services on the way through. So those would be, the big areas, as opposed to trying and think of ways in which, banks are encouraged to do piece. It's really interesting the difference between the larger banks and the smaller banks, even on those returns to capital relative to risk. We've got the average there. The difference is quite significant, and so this is where the innovation side is really needed, and it's happening globally. It's not happening as quick here in New Zealand.
Nicola.
What extent do you think that the settings which require New Zealand banks to hold so much capital have contributed to their profitability?
Profitability seems to remain very strong, even though capital is rising, and it's great to see that the profitability is being used, the returns, to build the capital buffers to where the banks are. It's not acting as a barrier to entry for small economies. Do you want to chat a bit? So it's not a particular.
But these charts seem to show that the small banks don't actually earn enough to cover their cost of capital.
But
is that sustainable?
I'll stop there.
Yeah, and when it comes to the capital review and asking banks, and particularly the larger banks, need to hold. Systemically important banks need to hold even more capital than other banks because of their importance to the stability of the system. From a bank's point of view, they want to be holding less capital for their profitability in terms of return on equity. From their perspective, they'd like to hold less capital to lift their return on equity. The efforts that we made through the capital review to lift those capital requirements were pushed back against on that basis. But as the Governor's mentioned, that the fact that they've been profitable through this recent period has enabled them to continue lifting their capital to meet those requirements that we have.
Do you think the funding for lending program helped boost their profitability?
We think it's one factor amongst many that have kept funding costs low through the previous period that we've seen. It was one scheme amongst many that was launched through 2020, through that period that we talked about earlier, with the extraordinary environment that we're in, the efforts that we had to keep interest rates low to give the economy the impetus to recover. It is one factor. That scheme is now shut, and really the banks are going to be looking forward, going, well, how do they fund themselves? Where do they get their funding from? And they'll have funding plans, which mean they need to be getting into wholesale markets. They need to be competing more aggressively for that term deposit funding. And we think that will be part of the story that we'll see their funding costs lift in the period ahead.
Has the Reserve Bank done any analysis, though, of just how much the funding for lending program and the stimulatory program during COVID added to the bottom line for banks. It seems that their profitability benefited massively from the quantitative easing program and the funding for lending program.
I don't have those numbers. We have looked at that. I don't have those numbers in front of me at the moment. A very, simple metric is just the percentage of their funding that came from the funding for lending program, which off the top of my head, it's of the order of less than 5% of their total funding.
It's a very small proportion of their total funding, and the big part was just low global interest rates and a lot of savings. So the banks around there globally, banks have had very low funding costs globally. Net interest margins have been heightened globally. That cycle is now turning, which was a cyclical component.
We've got some other questions on this. So I'm going to ask members to keep their questions short for this part. If they're not, I'm going to disallow the question.
I did want to get into that, but it was actually on the capital requirements. You note that vulnerabilities are highest amongst the ag sector and commercial property operators, but from my recollection, the highest risk-rated capital requirements that you have are for ag, extraordinarily so, and for commercial property. And Christian, you were saying before that, the value of having a tool like the LVR is that you can ease off when, and that's what lends itself to the efficiency of those tools. But we've had those really high capital requirements, for ag. So I'm just kind of wondering what other tools you have to reduce the vulnerability or exposure in those spaces.
Limited. And risk, look, I think you're talking about risk weights in terms of risk-weighted capital, and they have to be measured around the risks that banks face from that type of lending activity. So they are something that we calculate based on historic
They've been static my point is that they've been static for ag from my recollection for 10 plus years.
And those risk weights are things that we don't change frequently. They are structural settings. Those macroprudential settings are more cyclical ones that we will change through the cycle. Risk weights are more structural. We will revisit those, however, if there is evidence. And we have had a recent consultation on a number of different areas where we are reviewing risk weights. I think the recent experience, maybe Chris, you want to talk about the risks from those sectors, don't look like they've lessened, and that would point you towards keeping those risk weights where they are rather than lowering
Which was the second part of the question around the other tools that you have to reduce those vulnerabilities or those risks in those sectors.
Well, we're building resilience into the financial system to those sectors. That's where we sort of fit in the chain in terms of what can we do. Very limited in terms of our impact directly on the dairy sector or directly on the commercial property sector.
And what we observe in the dairy sector in particular is the structure of the industry, the high leverage nature of the industry leads to a very high vulnerability to shifts in interest rates up and down. So it's great to see, Chris, overall it's down significantly from historic periods.
Yeah, certainly seen it in terms of your kind of debt relative to production numbers. They've come off quite significantly from where they were 5 years ago. It was a period when we were really highlighting the dairy sector as being there's a vulnerability for that sector. So the fact that they've reduced those means that they're a little bit more resilient now for situations like we're seeing today where interest rates are rising. The forecast for payouts for next year are looking a lot lower. Cost pressures remain. So there's definitely challenges in the sector. So it's important to have that improved position.
Supplementary, Simon Watts, then we'll go to a quick supplementary, Simon Court, and then a final question from David.
Yeah, it's just building off the comments by Nicola Willis. Tables 4.2, 4.1 look at return on assets between the big banks and the building societies. Building societies sitting at 1.5%, big banks sitting at 5%. Isn't it simply a fact that your one-size-fits-all regulation is in effect adversely supporting the big banks and negatively or adversely impacting the building societies, acknowledging they are a very small portion of the total system, but they didn't have access to the funding for lending program. They didn't have access to that cheap debt. And you're starting to see it through in terms of some of the ratios.
Yeah. So I'll take this in sort of turn. I mean, we think that
deposit takers across the board benefited from the actions that we took in terms of the LSAP program, the funding for lending program, by lowering overall interest rates, and that include effectively lowering the market for deposit rates, which is a key part of their funding. And in terms of the return on assets and the like from building societies, we think the key factor is the economies of scale in terms of the credit unions and the building societies struggle relative to the large banks in terms of the economies of scale.
Not
their
the
ability.
compliance burden that not the compliance burden that you're placing on them, i.e. treating them the same as the big banks.
Well, I'll talk about proportionality. So we think that that's the key factor, the economies of scale. In terms of the one-size-fits-all world, as you know, we are doing a lot of work on proportionality. This is one of the key bits of feedback from the committee, is to outline a proportionality framework such that we can explain how we won't be applying a one-size-fits-all approach to regulation going forward. At the moment, there is already an element of proportionality in the way that we do regulation. We are stricter on the bigger banks. They do need to hold more capital. They have more requirements for outsourcing and various things. And the non-bank deposit takers currently aren't subject to the regulation that deposit takers bank deposit takers are. One really important point I think we need to get across is that even in a world where we move to a more proportionate approach, that can't be at the expense of financial stability, in the sense of, yes, we can make things proportionate by ensuring things are simple, easy to implement, lower the compliance costs and the like, but we still need to ensure that the financial system is strong. And I think the experience that we talked about with the US banking system earlier in the conversation is a good sort of example of getting proportionality wrong. In the sense of applying.
With respect, their capital ratios are higher than the big banks. We're not talking, your data indicates that in the back table. So look, I don't think we need to go.
You don't need to answer that. We're going to Simon Court for a very quick sub, Simon, and then we've got one more primary.
Yeah, thank you, Madam Chair. I just want to come back to the pockets of vulnerability in the agricultural sector. There's been reports that banks are becoming much more reluctant to lend to farmers as they're required to comply with disclosing their climate-related risks since 1 January. There's been a number of reports that producers are finding it harder to refinance, and in particular in the wake of the cyclone and the damage that's been done. Would the bank have an opinion on whether this disclosure is actually increasing vulnerability for the agricultural sector?
Chris, do you want to talk to the insights we have on the agricultural
It's really
sector?
about, is this climate-related disclosures, mandatory disclosures, actually exacerbating the vulnerability of the agricultural sector?
Yeah, Adrian?
Yeah, no. The risks are real. We want to make sure that the risks are priced in, so that the borrowers and lenders understand what they're entering into. So that is the relative price signal is probably the most powerful way of making sure that borrowers don't get into situations that are unsustainable.
But I mean, is the risk that the agricultural sector, New Zealand's ag sector, would be the only farming sector in the world subject to emissions pricing? Is that part of the risk?
I would say the biggest risk to the farming sector is the climate itself. And it wouldn't matter what the relative price is if people are unprepared to, that people just will not lend money to areas that they believe would be vulnerable.
David Clark, final question.
Thank you. And question just around, and is weather related actually, around the insurance sector response to the significant weather events. 3 questions, and I'll get them out quickly because we've only got a couple of minutes. And so, to what extent were weather events priced into premiums in your estimation? Secondly, what does that say about the maturity of the sector? And thirdly, looking forward, do we think people are adequately insuring? Because premiums will be changing as a consequence, we've been told.
Yeah, so these were the two largest weather events for the insurance industry in quick succession within the matter of a couple of weeks. We took, what we are confident about was that the insurance industry was well placed to absorb those events through the capital profitability, and part of that's going to be through the premiums that they charge to build those capital positions and that profitability and the reinsurance that they had in place. What we are picking up is that as they go into reinsurance renewals to protect themselves from further events, that is a tougher environment for them to be in now. Those costs of reinsurance are rising. We're expecting, to see that be reflected through into higher insurance costs to consumers. We're aware that while the insurance industry could withstand this event, there are, underinsurance is an issue in New Zealand. That's going to continue to be an issue that the likes of the Council of Financial Regulators are going to have to lean into.
Can I ask, in terms of that challenges with reinsurance, presumably that is as a consequence of the global reinsurance situation more than the local one, because New Zealand's a pimple in this whole equation in terms of the overall cost, and they typically look at us as Australia and New Zealand combined anyway.
Yeah.
Is it true that is really being driven by the global situation rather than by the weather events here, or do you see an effect from the weather events here?
I think that is. I think you're correct. I mean, climate change is a global event, and generally, reinsurance is about offsetting one part of planet Earth with another part of planet Earth around the insurance. But it is a significant impact for all. So you haven't got that the benefits of that reinsurance as significant as it was, and it's probably here and now in ways that weren't anticipated and paces that weren't anticipated as well. But the real challenge will be not only just how the private sector insurance impacts, but central government, local governments around the rules, the regulations, what can and can't be done. I think we're all well versed in the standoff that's there at the moment around adaptation and mitigation.
Thank you very much. And on those small thoughts for another day, thank you very much, Adrian Orr, Christian Hawkesby and Chris McDonald for coming in, spending your time providing us with the report and answering our many questions. We look forward to seeing you again in due course.
Thanks a lot.
More and more countries around the world are seeking alternatives to the US dollar, the global reserve currency that has dominated the international financial system since the end of World War II. And it's not only countries that the United States targets with its very aggressive foreign policy, countries like, for instance, Russia or Iran or even China. In fact, even longtime US allies are trying to hedge their bets. They're diversifying their international trade and experimenting with using other currencies. And they're also diversifying the foreign exchange reserves their central banks hold. And a good example of this is Saudi Arabia, a country that for decades has been one of Washington's most loyal allies in the Middle East, or a better term is West Asia. What we've seen is recent reports in the past few years that Saudi Arabia is considering selling its oil in other currencies. Of course, Saudi Arabia is one of the world's largest oil producers. And specifically, the Chinese president, Xi Jinping, announced that China is talking with Saudi Arabia about buying oil in China's currency, the renminbi. And this has very much angered the United States. So there have been reports in the US media, specifically in the newspaper The Wall Street Journal, this August 2023, revealing that Washington is pressuring Saudi Arabia as part of a series of diplomatic negotiations and trying to force the major oil producer to price its crude only in dollars, not to experiment with selling its oil in other currencies. The fact that this is even up for debate represents the profound geopolitical and economic shifts we are seeing in the world today. Since the 1944 Bretton Woods Conference, the US dollar has dominated international trade. It has been the global reserve currency. And since the 1970s, as we'll talk about later in this analysis, Saudi Arabia had an agreement with the United States where it would sell its oil in dollars. But the geopolitical winds are moving in a new direction. China now has the largest economy in the world when you measure its GDP using purchasing power parity, which is a much better metric. Since 2017, Beijing overtook Washington and has the world's largest economy. China is the largest trading partner of many oil producers like Saudi Arabia. And the new Cold War that the United States is waging on China has put many countries around the world, even longtime allies like Saudi Arabia, in a difficult situation where they're trying to maintain good relations with both sides. And today I'm going to be talking about the extremely important geopolitical and economic repercussions and implications of the diplomatic negotiations going on between the US and Saudi Arabia, involving China, involving Russia, involving Israel, and much more. One of the main ways in which the United States has maintained its currency, the dollar, as the global reserve currency over many decades is through the petrodollar system. What does that mean? It means that the vast majority of oil sales in the world are priced in dollars. This means that if you're a country that doesn't have oil and you need to import oil, usually, almost always, you need to get access to dollars in order to pay for that oil. And because so many countries around the world rely on importing oil and other commodities, that means they need a lot of dollars. That maintains international demand for the dollar, which helps to stabilize the dollar system. And it also allows the United States to maintain a massive trade deficit with the rest of the world. It allows the United States to import and import and import much more than it exports. One of the key players in this petrodollar system is Saudi Arabia. For decades, Saudi Arabia has been one of the world's largest oil producers. Saudi Arabia also plays an important leadership role in OPEC, the Organization of Petroleum Exporting Countries. And historically, Saudi Arabia's state-owned oil company, Saudi Aramco, has increased or decreased production in order to change the price of oil on the global market. As of 2022, it was the second largest oil producer in the world, representing 12% of global oil production. And actually, in first place was the United States, representing 20% of global oil production. It was the Barack Obama administration that massively increased oil and gas production in the U.S.
You know, I know we're an oil country, and we need American energy, and by the way, American energy production. You wouldn't always know it, but you know, it went up every year I was president. And you know, that whole suddenly America's like the biggest oil producer and the biggest that was me, people. I just want you to it's a little like, you know, sometimes you go to Wall Street and folks will be grumbling about anti-business. I said, have you checked where your stocks were when I came in office and where they are now? What are you talking? What are you complaining about? Just say thank you, please.
And those policies have been maintained under Donald Trump and Joe Biden. Also, by the way, Russia is the world's third largest producer of oil, representing around 11% of global crude production. Although, of course, the U.S. has been waging a new Cold War on Russia. So the U.S. realistically is not going to be able to negotiate oil prices in the global market with Russia, but Washington frequently negotiates with Riyadh and tries to pressure it to either decrease production or increase production when the United States wants to change the price of oil on the global market. In fact, in the past year, we saw a prime example of this with the inflation crisis in 2022. This was caused by a variety of factors, including the proxy war in Ukraine, the Western sanctions on Russia, one of the world's biggest producers of oil and other commodities, and also because of supply chain shocks when the world was coming out of the pandemic and reactivating economies. And in an attempt to decrease the inflation in the United States, President Joe Biden visited Saudi Arabia in July 2022, and he tried to pressure Riyadh to increase oil production, which would increase the supply of oil in the global market and would potentially lead to a decrease in global oil prices. And because an increase in oil prices often leads to an increase in consumer price inflation, this was a way for the US to try to reduce inflation. And not only did Saudi Arabia say no, not only did Saudi Arabia refuse to increase production to help decrease inflation, Saudi Arabia decreased production, which increased the price of oil on the global market. So what we've seen in the past few years is as the United States and Saudi Arabia, as their historic relationship has been weakening, we've seen that actually Saudi Arabia is going against what Washington wants. And there have even been reports that Saudi Arabia is considering pricing its oil in other currencies, primarily China's currency, the renminbi. Now, earlier I mentioned a Wall Street Journal report that reveals that the United States is pressuring Saudi Arabia to continue selling its oil only in dollars, not in China's currency, the renminbi. This is part of an article that's actually about diplomatic negotiations, largely involving Israel, at least ostensibly, although it's actually much more about China. And this article is titled, "Saudis Agree with US on Path to Normalize Kingdom's Ties with Israel." Although I think if you read the article, you'll see that the headline is actually a bit misleading. So let's take a look here. The report states that the US and Saudi Arabia have agreed on the broad contours of a deal for Saudi Arabia to recognize Israel in exchange for concessions to the Palestinians. Although, again, if you read through the article, you'll see that that is really exaggerating. However, the fact that they're even discussing this is a major betrayal to the Palestinian people. Historically, Saudi Arabia has claimed to support the Palestinian struggle against Israeli colonialism. And today, millions of Palestinians live under a system of brutal apartheid. The fact that this is an apartheid regime is not even controversial. It's an objective fact. I mean, many people have been saying this for years, but even the mainstream Western human rights organization, Amnesty International, which is very biased in the interest of the West, even they have admitted that Israeli authorities must be held accountable for committing the crime of apartheid against Palestinians. I actually talked about the implications of this Amnesty report with friend of the show, Ali Abunima, a great Palestinian-American journalist. I will link to the video in the description below of our discussion of how Israel is an apartheid regime. But anyway, any country that is willing to normalize relations and support this apartheid regime is clearly abandoning the Palestinian people. And the fact that Saudi Arabia is considering this shows that they've never really been committed to defending the Palestinian cause, committed to fighting against Israeli colonialism backed by the Western powers. This is not something new, but what did happen is under US President Donald Trump in the so-called Abraham Accords, Washington pressured the United Arab Emirates and Bahrain to normalize relations with apartheid Israel. And now the Biden administration is pressuring Saudi Arabia to do the same. However, if you read this report from the Wall Street Journal, you can see that a big part of these negotiations that are ostensibly about Israel-Palestine is actually involving China and Washington's attempt to cut off Saudi-Chinese relations. Now, the article reveals that Saudi Arabia wants help from the United States in order to develop a nuclear program. And ostensibly, this is a civilian nuclear program for nuclear energy, but we all know that Mohammed bin Salman, the crown prince of Saudi Arabia, has expressed interest in having nuclear weapons. He wants Saudi Arabia to be a more significant power, and he thinks that getting nukes is going to help him. So essentially, the US is helping Saudi Arabia move toward getting nuclear weapons. And in return, the United States is pressuring Saudi Arabia to reduce its growing relations with China. According to the newspaper, the Biden administration has three main demands for Saudi Arabia in these negotiations, ostensibly about Israel, but actually about China. First of all, the United States wants to assure that Saudi Arabia will never allow China to build a military base in the kingdom. Second of all, the US is trying to pressure Saudi Arabia to cut its ties to Chinese tech companies. Specifically, it wants Saudi to cut its relations with Huawei, the major Chinese tech company. This is part of Washington's tech war against Chinese firms. The US has imposed sanctions blocking the export of technologies involving semiconductors and quantum computing parts and AI, artificial intelligence technology, to China. So that's the second demand. And then the third, and I would argue most important demand revealed in this article, is the US wants assurances that Riyadh will only use US dollars, not Chinese currency, the yuan, to price oil sales. I personally think this is probably the most important factor when you consider how crucial the petrodollar system is for maintaining US economic hegemony and therefore US political hegemony. And of course, this is exactly what US-Saudi relations have been based on since the very beginning, going back to the famous visit by Franklin Delano Roosevelt, President FDR, on his last Valentine's Day, the 14th of February, 1945. He met with the Saudi king, Ibn Saud, in Egypt, off the coast in Great Bitter Lake, on the ship, the USS Quincy. And famously, the agreement was made where the United States would provide support for Saudi Arabia, would protect the kingdom, and in return, the kingdom would provide oil to the United States. Now, what this Wall Street Journal report really acknowledges, in addition to the fact that, Saudi Arabia is considering betraying the Palestinians and recognizing apartheid Israel, and the fact that they're even willing to negotiate, is preposterous, because you can never trust the Israeli apartheid regime, especially right now with the far-right fanatic Benjamin Netanyahu back in power. I mean, the fact that they're even considering this is outrageous. But I actually think one of the more important revelations of this report is the fact that the United States, we have evidence that the United States is pressuring Saudi Arabia not to sell its oil in China's currency, in yuan. And it's an acknowledgement of how big of a threat de-dollarization is to US economic hegemony. It's clear that Washington is very concerned about the growing relations between Beijing and Riyadh. And the reality is that, again, China is the world's largest economy when you measure it for purchasing power parity. It has been since 2017. And China is Saudi Arabia's largest trading partner. So it only makes sense for them to deepen their relations, especially when you consider the fact that for a decade now, China has bought more oil from West Asia, from the Persian Gulf region, than even the United States. It's the largest purchaser of oil in the region. So why would Saudi Arabia sabotage its relationship with its largest customer, the largest purchaser of its exports? It doesn't make any sense. And I have no sympathy for the monarchy in Saudi Arabia. I do not. I think it's an awful political system, but it's also one where the people running it are rational. They are logical people, and they're not going to cut off their arm in order to appease the United States. The reality is that the situation in the world economically and geopolitically has shifted drastically. It is no longer the 1940s. Saudi Arabia now has other countries it can do business with, like China, like Russia, like India, like Iran. And I'll talk about later the new diplomatic relations that China helped to negotiate between Saudi Arabia and Iran. The world is no longer the unipolar order dominated by the United States. So Washington keeps trying to pressure countries around the world to sabotage their relations with what is in many cases their largest trading partner, China. Today, there are more countries around the world whose largest trading partner is China than countries whose largest trading partner is the United States. And as the Chinese economy continues to grow year by year, and as the US economy has stagnated, that situation is only going to continue to move in the direction of Beijing's advantage, not Washington's. Now, back in December 2022, China's President Xi Jinping took a historic trip to Saudi Arabia, and in Riyadh, he signed a series of agreements with the Arab League, and there were representatives from dozens of Arab countries there. And he also signed agreements with the Gulf Cooperation Council. And while in Saudi Arabia, President Xi made an incredible speech. He revealed that the countries had come to an agreement by which China would buy oil and gas from the Persian Gulf region using its own currency, renminbi, or the unit of the renminbi is the yuan. And I'm going to read here from a Reuters report from back in December. This is a quote from President Xi. China will continue to import large quantities of crude oil from GCC countries, expand imports of liquefied natural gas, strengthen cooperation in upstream oil and gas development, engineering services, storage, transportation, and refining, and make full use of the Shanghai Petroleum and Natural Gas Exchange as a platform to carry out yuan settlement of oil and gas trade. That last line is the most important. To carry out yuan settlement of oil and gas trade. This is a direct challenge to the petrodollar system on which the hegemony of the US currency is based. Just a few weeks after Xi made those comments, there were similar remarks by Saudi Arabia's finance minister, and this is a report from the website oilprice.com titled, Saudi Arabia is open to discuss non-dollar oil trade settlements. So the finance minister made it clear, public for the first time, that yes, Riyadh is considering the possibility, it is open to the possibility of pricing its oil in other currencies, not just the dollar. Although I do want to clarify that there has not been a public announcement of this happening. Thus far, it has really just been a debate going on. There have been some reports in the financial press in the West that Saudi Arabia is considering this. In fact, the Wall Street Journal published a report in March 2022 titled, Saudi Arabia considers accepting yuan instead of dollars for Chinese oil sales. But again, these are just talks, they're just negotiations. We have not seen this happen yet. In fact, what we have seen is that the United Arab Emirates, a neighbor of Saudi Arabia in the Persian Gulf region, the UAE has actually sold natural gas, liquefied natural gas, to China in Chinese yuan, and actually did it through a French company, Total Energy. So there is a precedent of this happening, and Saudi Arabia may do it. But thus far, there's been a lot of speculation. We don't really know what's going to happen. And the latest report from this August 2023 in the Wall Street Journal revealing that the US is pressuring Saudi Arabia not to price its oil in yuan suggests that maybe there still is room for maneuvering here. This is something that's still up in the air. But again, the fact that there is even a discussion of this shows how significantly the global political and economic order has shifted just in the past few years. I mean, a decade ago, or at least 20 years ago, this would have been unimaginable. Now, earlier I mentioned that back in the 1970s, Saudi Arabia made an agreement with the US that it would sell its oil in dollars. This is the petrodollar system that was created. And this is not just a rumor. It's not just an urban myth or something. We have evidence of this. I'm going to look here at a report in Bloomberg, the business media outlet, back in 2016 titled The Untold Story Behind Saudi Arabia's 41-Year U.S. Debt Secret. And it talks about in 1974, this is toward the end of the Richard Nixon administration, and the newly appointed U.S. Treasury Secretary William Simon, took a trip to Saudi Arabia, and he also did this in collaboration with Henry Kissinger, who of course was a top official overseeing foreign policy under Nixon. And the goal of this trip was to neutralize crude oil as an economic weapon and find a way to persuade Saudi Arabia to finance America's widening deficit with its newfound petrodollar wealth. That's what Bloomberg says. And it notes that the basic framework of the agreement made was strikingly simple. The U.S. would buy oil from Saudi Arabia and provide the kingdom military aid and equipment. In return, the Saudis would plow billions of their petrodollar revenue back into treasuries, therefore financing America's spending. This point is absolutely crucial because the United States has been getting a free lunch for decades. We're often told that there's no such thing as a free lunch. Well, the people who say that don't have an empire. The US has an empire it uses to give itself a free lunch. The reality is that most countries around the world, if they maintain a constant current account deficit, that is a trade deficit with the rest of the world, if they're constantly importing more than they're exporting, what that does is it devalues their currency in relation to the currency they use to pay for those imports, which is usually dollars. So usually, if you're a country like Argentina and you're constantly importing oil and you have to get dollars, usually what's going to happen is with that constant current account deficit, your currency, say the Argentine peso, will depreciate, will devalue against the US dollar. So it helps strengthen the dollar and weaken your currency. And at least hypothetically, what economists often say, although it doesn't really end up working out this way, is what this does over time is it will devalue your currency, and what that does is it makes imports more expensive because you have to get the foreign currency to pay for imports, but it's harder to get the foreign currency because your currency has depreciated against it. So over time, imports become more expensive, but also exports become less expensive, so you become more competitive. So over time, hypothetically, it will increase the competitiveness of your country's exports and it will help balance your trade. However, that's actually not what happens for a variety of reasons, largely because economics doesn't work like we're told in the neoclassical textbooks, where everything is based solely on utility maximization and supply and demand, and there are no market failures, and everyone is a perfectly rational agent who never acts irrationally. Anyway, whatever. The point is that the United States has maintained a massive current account deficit, a massive world historic trade deficit. So in the 1970s, largely because of US military spending on the Vietnam War to maintain its empire of bases around the world, the US began having a current account deficit, and it grew in the 1980s drastically, and it continued growing and it skyrocketed in the 2000s, and today it is just massive. We're talking about a current account deficit in 2022 of nearly $1 trillion. I repeat, nearly $1 trillion. And for most countries, for almost every country on earth, if they were to maintain a massive current account deficit like this, it would lead to a significant devaluation of their currency. But the dollar hasn't significantly devalued. And why is that? Well, there are a variety of reasons. One is simply because of the power of the US military, which can threaten any country around the world that tries to de-dollarize and overthrow their government. That was a factor in the wars against Libya, against Iraq, against other countries. So that's certainly one factor. Another significant factor is simply that the US has open capital markets and a lot of ways to invest in US corporations, in the stock market, in US treasuries, which are seen as very secure and stable, largely because the US has this massive empire and it can, overthrow any foreign country. So it's seen as the most stable currency. And there's a psychological element because people believe the dollar is the most stable currency, they hold their wealth in dollars and in US Treasury securities, dollar-denominated assets, and the psychological element, because they believe it's stable and investors invest in it, that actually makes it stable. So a huge part of this is actually just political and psychological. But finally, another very significant factor in maintaining the hegemony of the US dollar, the stability of the US dollar, in allowing the United States to maintain these massive current account deficits over many decades, is precisely because of the petrodollar system, because so much international trade involves the US dollar, because countries that import primary goods, commodities like oil and gas and foodstuffs and minerals, they often have to get dollars in order to pay for those imports. That maintains an artificial demand all around the world for dollars, which helps to finance the US current account deficit. So the US is sucking in wealth from all over the world, and no other country could do it. So the point is that oil plays a key role in this system. This is the system of imperialism. And Saudi Arabia particularly plays a central role of maintaining the hegemony of the US dollar at the heart of the imperialist world system, of which Wall Street is the center, of which the United States is the center. So that's why today I wanted to talk about this very interesting development, this historic development, where Saudi Arabia is considering potentially selling its oil in other currencies. And clearly, the United States is very concerned about this. That's why Washington is demanding that Riyadh not price its oil in Chinese yuan as part of negotiations ostensibly over Israel, not China. But as we see, we're in a new Cold War, and pretty much everything the US does today is all aimed at trying to weaken China. Welcome to Cold War II. And here at Geopolitical Economy Report, this is exactly what we analyze every single week, talking about the new Cold War, the geopolitical and economic implications. I'm Ben Norton, the editor-in-chief.
Hello, everybody. This is Pascal from Neutrality Studies, and it is my very great pleasure to talk tonight to nobody else than Dr. Jeffrey Sachs, an academic superstar here on YouTube. You really have to say that. He is one of the United States' most outstanding and humanistic public intellectuals. He's a professor and director of the Center for Sustainable Development at Columbia University. He's a man who researches and then actually speaks out about the things that others barely dare to contemplate, be that about the corona craziness or about the war path his country is on. Professor Sachs, thank you so much for coming online on so early on a Monday morning.
It's a pleasure to be with you. Thank you so much.
Professor Sachs, you gave a wonderful talk in Austria a few months ago, which I will link to here. For our bilateral discussion, let's build on that Austria talk of yours and first discuss this question that has been haunting me, which is the neocons and neutrality. So neocons, rather than using neutrality for strategic balance, they have time and again gone against this concept, right? And a lot of people don't know that in the Ukraine conflict, Ukraine until 2014 had a neutrality clause in its constitution, and that then was thrown out of the window together with, the democratically elected president Yanukovych and everything that happened. And just recently, we learned that also in Pakistan, the United States probably had its fingers in the ousting of Imran Khan, and we have now a memo that leaked where Assistant Secretary of State for the Bureau of South and Central Asian Affairs, Mr. Donald Liu, talked to the Pakistani ambassador, and he literally said that the United States is not willing to allow this aggressive neutrality. He used the term aggressive neutrality of Pakistan to continue. Now, it is no wonder that the hegemon and biggest belligerent kind of is against neutrals. That's just natural. They are second-tier targets. But what surprises me is that these neocons are not willing to use neutrality as a way to create strategic stability, which would would be beneficial also to the United States. Do you have an explanation for that?
I think the explanation is straightforward. The neocons are not interested in strategic balance or strategic stability. They're interested in global hegemony. They adopt and pursue the idea that the United States is, should be, and can remain the world's sole superpower. This is absurd in substance, because the United States is not, cannot, and should not be the world's sole superpower. The United States is 4.2% of the world population. It should do its share. It should be responsible. It should promote strategic balance, not hegemony, or what some in the US security state call full spectrum dominance. The neocons are not interested in balance. They are therefore actually undermining balance wherever it is. The whole reason for the war in Ukraine is the United States could not accept a mutually respectful peace with Russia. The United States had to keep moving NATO eastward to surround Russia. The United States does not accept a mutually respectful relationship with China. The United States wants to surround China with its military bases and military alliances. This is why the situation is so destabilizing, because the United States is not, and by the United States, by the way, I don't mean the US people, I mean the security state, which is dominated by this arrogance of unipolarity. They're not seeking stability, they're seeking dominance. And seeking dominance is not only, I think, immoral, but utterly impracticable, because the United States is not dominant. It is one of many powerful countries in the world, but there are many major powers in the world, and the United States seems intent to take them on. It won't succeed, but it will leave bloodshed, massive bloodshed, in the places that are trapped between the superpower fights, and Ukraine is the latest victim. It was a victim that was talked into its role by promises by the United States that we'll defeat Russia together. Of course, in the end, Russia is not defeated, but Ukraine is reduced to rubble. And this is unfortunately the American tendency.
Now, where do you think leaves us this insight, like for neutrality and non-alignment, especially for countries that are really kind of trying to be non-aligned, not this kind of lapdog neutrality that Austria and Switzerland and Ireland are going, because they have already been captured pretty much by the ideology, by the same ideology. But those states in Africa, South America, and India and Southeast Asia that don't want to go along, I mean, this puts a target on them as well, right? The United States will see any kind of third-party policy as inherently antagonistic. I mean, these neocons, the Victoria Nuland types.
Well, I think that from a strategic point of view, each region needs to get together so it's not picking off one country at a time, but actually regions cooperating. So I strongly advocate that ASEAN work together as a group. I advocate that the South American countries, indeed, it would be good if the Latin American and Caribbean countries, but at least the regions, work together as a group. The United States approach is divide and conquer, the old strategy that dates back 2,000 years to the Roman Empire. So it picks off Venezuela, and then it divides Latin America between those who are on the US side against Venezuela and those who are on the Venezuelan side. But what, of course, is the right response for Latin America is don't be divided that way. If you are divided that way, everybody loses. Millions of refugees from Venezuela that came from a brutal and premeditated attempt by the United States to overthrow the Maduro government. And who pays the consequences? All of the region, of course, Venezuela first in a shocking collapse of the economy and social life, but Colombia and other neighboring countries that have become home to millions of refugees from Venezuela. So I'm extremely happy, although it's very difficult, that Lula is back in the presidency in Brazil, because Lula can bring together the Latin American governments to say to the United States also, look, we're not your enemy, but stop dividing us. Stop trying to overthrow governments in our region, because we don't want that. And that really needs to be the response everywhere. The United States traps countries in proxy wars, and those countries lose. I tried to tell my Ukrainian counterparts, they were at that time my Ukrainian friends, then they stopped listening to me and wanting to repudiate what I was saying, but I kept warning them, you are going to get trapped by the United States. And this is exactly what has happened.
Do you have any more hope for Taiwan? Because it seems to me the US is trying to do exactly the same now, with preparing Taiwan to be an unsinkable aircraft carrier and then have bloodshed on without end on Taiwan in order to fight a proxy war with China.
I was just in Taiwan. I was given a wonderful award called the Tang Prize by a fantastic foundation. I spoke to a major Buddhist foundation in Taiwan, the Tzu Chi Foundation. And what a wonderful society, what a successful place. And I gave the warning everywhere that I could, don't get trapped into this U.S. PRC fight, because this would be devastating. The United States basically is led by a lot of ignoramuses. I happen to know a lot of them. They're very poorly educated. They're educated in a kind of American arrogance. They are outdated by 30 years, thinking that the world is just at the U.S. Doorstep, or that the U.S. has the prerogatives, I should say better, anywhere in the world. They don't know what they're doing. And I tried to say to Taiwanese leaders, be careful, because this is really what happened in Ukraine. Now, the U.S. approach is so mind-bogglingly wrong-headed. It says the way to protect a country is to arm it. Well, this is the fallacy that my late and great colleague at Columbia University, Robert Jervis, wrote about for decades, what he called the security dilemma. The United States may look at arming a country as a, quote, defensive action, but from the point of view of the country on the other side of that arming, that looks like a pretty aggressive action, and it therefore triggers a response. It triggers a retaliation. It makes conflict more likely. So the United States poured arms into Ukraine after 2014. It thought it was going to make peace that way. Well, yeah, maybe some of these dunderheads in Washington believed that, but of course it was leading towards conflict. And the idea that the way to protect Taiwan is by making Taiwan what they call in Washington a porcupine, so armed that it won't be touched, with all those quills protecting it. This is absurd. The arms shipments would only make Taiwan more and more endangered, more and more at risk. The way to reduce, even eliminate these risks is diplomacy. Diplomacy between the United States and China, diplomacy between Taiwanese leaders and mainland Chinese leaders. Talk with each other. For heaven's sake, there is an absolute vital interest on both sides of the Taiwan Straits for peace. There really is. And if the United States would just get out of the way for a moment and the two sides could talk with each other, they'd actually find a way forward. But the United States comes in with its naive and destabilizing promises. We'll keep you safe. Yeah, they'll keep Taiwan safe like they kept Afghanistan safe, like they kept South Korea safe, like they kept Ukraine safe. In other words, not at all. And how many failures do these neocons, how many failures are they going to have before they are finally taken off the pedestal of power? By the way, it's not that the American people believe any of this. It's just that we don't have a functioning representative government. Our foreign policy has been taken in the hands of Raytheon and General Dynamics and these neocons. The American people are asked nothing about this. So this is not a reflection of the martial spirit of the American people, although our mainstream media feed a lot of absolute falsehoods to the American people. But it is the fact that foreign policy is in the hands of the security state, that is governed economically by the military-industrial complex, which funds the major committees in Congress, which provide the votes and the money for a $1 trillion plus annual military outlay. And that's where we are right now. It's absolutely awful. In the United States, foreign policy is the small preserve of the military-industrial complex.
I share that analysis with you. The oxymoron to me is that the United States keeps talking about itself. So, and I apologize again, the same people that you're talking about keep talking about the United States as a force for good and a force for peace, when in reality, the United States is highly militarized, highly militaristic, and reacts to conflict always with military components. That surprises me.
Well, I would add, I think since the end of the Second World War, the United States has been the most militarized and most violent country in the world. And this is just a matter of record. One recent scholarly account, a very good one, counted 70 US-led regime change operations between 1947 and 1989. So the study was over the Cold War period. And just in that period, 1947 to 1989, 70 regime change operations, 6 of which were overt wars to overthrow a foreign government, and 64 were covert operations. Now, this is stunning. First of all, covert operations don't remain covert. It's pretty obvious if you're a reader of the New York Times, which wants you to suck your thumb and go to sleep. But if you're a thinker who's looking at the actual evidence, pretty clear when the U.S. is covertly overthrowing another government like it tried to do in Syria. Now, the point is that this is the normal U.S. modus operandi: war, coups, and overthrows. And after 1989, the big change wasn't that the United States stopped that behavior. The big change was the United States thought it could get away with anything, whether in Iraq, in Afghanistan, in Syria, in 2011. Obama and Hillary, well, they decided, okay, we're going to overthrow Assad. That was just a conscious decision. And 12 years later, they left that country in shambles because they're fools. What do they think? That they can dictate? By the way, they said, both Obama and Trump, okay, we're going to overthrow Maduro. We'll do it through economic sanctions. They crushed the economy. And as stupid as they are in Washington, they said, okay, we'll now pretend that Maduro's not the president. We'll just name another president from outside, Juan Guaido. And you have to think, is this a cartoon? Is this a fairy tale? Are these idiots? that they think that from Washington they can name the president of Venezuela, but they actually tried to do this for several years. And I have friends in, well, they wouldn't call me friends, but in academia in the East Coast in the US that said, okay, I'm going to work for the new Guaido government. And I said, Guaido government, because the US names him as president, he's suddenly president, you're going to work for him? Come on. So this is a deep and continuing tendency. The United States, it seems to me, forgot any kind of diplomacy. Diplomacy means you sit down and you negotiate mutual concerns. And by the way, to be successful, you show respect to the other side. And you try to listen to the concerns of the other side so that you can find a durable solution. That whole approach has completely gone. They don't even know how to negotiate. They have no interest in negotiating. They don't talk about it. This is amazing to me.
And there is actually a new study that shows that the rate of foreign intervention of the United States picked up after 1989 and didn't slow down. So the idea that the end of the Cold War would reduce interventions is actually wrong. This can be shown now. And one last question to you. Reconciliation with Russia. You wrote recently a wonderful piece on your homepage about how Kennedy would have made peace, and I mean John F. Kennedy. And in that piece, though, supposes two things. One, Kennedy supposed that the US and USSR were equals, and two, he supposed that both states wanted to make peace. Now, it strikes me that both of these assumptions are not true anymore. Or do you think the US thinks of Russia as an equal and as somebody that they want peace with, unless it is with Russia in broken up?
Well, the neocons had a plan to try to either overthrow Putin or to so-called decolonize Russia. I mean, it's a vulgar thing. They didn't want to deal with Russia as a counterpart country for negotiations. On December 17, 2021, President Putin put on the table a draft US-Russia security agreement. This was the last off-ramp to avoid the Ukraine escalation in 2022. I urge the White House, talk now. Based on that document, there's a lot in there that's absolutely valid. Most importantly, stop the NATO enlargement to Ukraine, which has no sense and which is a Russian red line for completely understandable reasons. No, we don't talk to any third party about NATO, is the US refrain. That means we don't negotiate, we don't understand diplomacy, we don't recognize Russia's legitimate security concerns. And you end up with wars this way. Now, I continue to believe to this moment that if Biden said the words, we will recognize Russia's legitimate security concerns in a legitimate peace agreement that also respects Ukraine's sovereignty, that respects America's security interests and Russia's security interests, we could actually get to a negotiated peace. And pretty quickly, it would be based on Ukraine as a neutral country. A fact that Zelensky himself noted in a brief moment in 2022 until the United States told him to stop noting that and demanded that Ukraine shut down the negotiations. So Zelensky actually came back to what had been the basis of Ukraine's independence, the basis of its constitution, and the basis of an effective foreign policy for Ukraine neutrality. He came back to that. The United States tried to shut it down. Well, of course, the US policy is failing badly, not for the first time, for continuously failing, because this is American foreign policy, but it's destroying Ukraine in the process. Can the two sides, US and Russia, actually still end this through negotiations, this war? Of course they could, even today. I keep saying, to Biden, if you want to talk, I'll give you my Zoom link. You can make a Zoom link with Putin. Go ahead. You want to borrow my cell phone? Call him. Start negotiations. They're basically cowards in the U.S. In the sense that they won't negotiate, because Kennedy put it right. He said, let us never negotiate out of fear, but let us never fear to negotiate. And they're afraid of negotiating in Washington, or they just forgot what it even means. So they don't have diplomats. I don't know what it is, but I've never seen anything like this. The absence of trying to find the way out of this disaster. And they need to open negotiations now.
Professor Sachs, it seems that we are repeating the obvious, but I'm very, very glad that you're speaking out so forcefully. You're an important voice for peace and an important voice for sanity. So thank you very much. And thank you for taking the time for talking to me today.
Excellent to be with you. Thanks to you.